It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance Live. Here's what we're watching this morning. Well, markets rebounding from yesterday's sell-off. The S&P coming off its worst one-day slide in about 3 months. Citi warning of more pullbacks ahead, but some good news for investors, saying that they should buy the dip.
And shares of Micron rising in the pre-market. The chipmaker forecasting strong recovery for demand in 2024, reversing a months-long downturn for the sector. Will AI enthusiasm keep fueling the tech gains in the new year?
Plus, Warner Brothers Discovery and Paramount are reportedly in talks to merge, first broken by Axios. But is WBD the perfect match for Paramount, or could there be a better partner out there? We're going to discuss all of that. Again, you're looking at shares under a bit of pressure here in pre-market action.
Well, the stock market rally stuttered unexpectedly on Wednesday, with all three major indexes falling, closing below Tuesday's session. The Dow fell 1.25% roughly, the S&P 500 roughly 1.5%, and the tech-heavy Nasdaq exactly 1.5% in declines. Citi encouraged investors to use this as an opportunity to buy the dip, with strategists writing in a note, the message is to expect pullbacks and buy into them. This is typically one of the tenors or the sentiments that prevails when you do have more of a market environment that has bulls running into some of even the more riskier assets out there, but really banking on what we've been talking about, especially coming off of the most recent Fed meeting, despite the dovish sentiment that we expected, or the hawkish sentiment that we expected to prevail, a little bit more dovish tenor prevailing there, pushing us into next year, and the market's looking on average about 6 months out, looking towards continued gains here, and ultimately that buy on the dip sentiment once again rearing its head.
Yeah, and you can see the losses across the board here, at least when you take a look at the performance that we saw yesterday. S&P, Nasdaq 100, Russell 2000, among those major averages there, indexes to pull back. We are seeing this so much optimism in the market. And one of the things that we have talked to strategists, investors about time and time again over the last several weeks, Brad, is whether or not this optimism is warranted, especially when you take into account how optimistic the market is, investors are about the Fed rate cuts next year versus what the dot plot is signaling. There is still this discrepancy in terms of expected rate cuts looking ahead to next year. And Citi making the point that they do see more volatility. They do see the risk of more of these types of pullbacks like what we saw yesterday, given the fact that we are still in this overbought territory. 19 of 24 industry groups, according to Citi, is in are at or near overbought ratings currently. So the message very clear to expect more pullbacks, but again, it's an opportunity for investors to buy into them and hold it for the long run.
Yeah, and more breadth coming is what we've continued to hear going into next year. And one area that some of the strategists and chief investment officers have been talking to us about is specifically small caps as well here, and that is continuing to be continuing to catch a bid here. So it's going to be interesting to see, especially if you're kind of layering on a profitability filter, as we were discussing yesterday with one of our guests, on even some of those small cap names, as the Russell 2000 does not have that profitability filter. The S&P 600, Liz Ann Saunders of Charles Schwab has reminded us before, has that profitability filter. Be interesting to see if that breadth also pushes more people to consider small caps, even on some of the dips.
Yeah, and we're the strategist here expecting S&P to end next year at 5,100 in terms of where he's seeing the most opportunity. He likes technology, industrials, also recently raising banks to overweight amid some of those more attractive valuations. Let's talk about the economic backdrop, because jobless claims out this morning, 205,000 Americans filing for first-time unemployment benefits last week. Now, that is less than expected, and also the latest sign that the economy is holding up much better than forecasters had initially expected. Real GDP is on track to grow 2.5%, unemployment remaining below 4%, and inflationary pressures are abating. But will this momentum continue into 2024, and what will the U.S. economy look like? We want to bring in Mark Zandi. He's Moody's Analytics chief economist. Mark, you're the perfect person to talk to about this. Obviously, you have been out with troves of data over the recent weeks, recent months here, just tracking the performance that we have seen. The economy has held up much better than most forecasters had anticipated. What does that then tell us about next year?
Well, I think it should be a reasonably good year. I think as long as American consumers hang tough and continue to do their part, continue to spend, I think the American economy will continue to move forward. And, you know, all the factors that you consider when considering consumer spending look pretty good. Lots of jobs. You mentioned the 4%. Sub 4% unemployment rate. Wage growth is now stronger than the rate of inflation because of the throttling back of inflation. Still a fair amount of excess saving among high income, high middle income households. Stock market pretty close to a record high. The housing values close to a record high. Most households have done a pretty good job locking in the previously low rates. Low income Americans, they're struggling, but middle and high income Americans are doing quite well. I think they'll continue to spend and the economy should be fine.
I mean, that's a lot of pressure on me, you, on Shauna, on everybody that's watching here today, Mark, just to continue spending, continue to showcase resiliency.
Oh, it's so tough. That's such a tough thing to do. Keep spending.
Yeah, exactly. I mean, Mark, when you think about if there are cracks in the resiliency of the consumer that are starting to show right now, where would they be? Where would you point to?
Yeah, I mentioned low-income households. They are under a significant amount of pressure. They got nailed by the high inflation. Even though inflation is moderating, they're still, we're all still paying a lot more for everything compared to a couple, 3 years ago. Food, housing, gasoline prices. So that's hurt. And of course, low-income households have turned to credit cards, consumer finance loans, and taken on debt. And now with these high interest rates, have to pay more in interest expense. So that's where, if there's an Achilles heel in the consumer, it's there. That's where I think the pressure will be. But here, just a statistic: folks in the top third of the income distribution, they account for 2/3 of the spending. So the American economy can't flourish unless we're all participating and everyone's able to enjoy the fruits of the better economy. But it can continue to move forward if high income, high middle income households continue to spend.
Mark, what we've continued to hear from the FOMC and its members is that wages aren't the primary driver still of inflation. However, what we've seen is some landmark deals come across as a result of labor negotiations, which also helps as a somewhat rising tide for certain industries where those negotiations have taken place, as employers have more pressure to raise wages to retain employees. So all that considered, do you believe that we're going to see, especially considering the resiliency that we've seen in household balance sheets to this point, do you believe that inflation could once again kind of rear its head sometime into next year if we do kind of see some of these sustained moves in rising wages?
Yeah, I'm possibly, yeah, but I think that's a kind of a low risk kind of scenario. I mean, wage growth is strong, but it is moderating. If you look at the plethora of the wage data, it says wage growth is about 4%. I'd say that's pretty close to where the Fed would want to see it to be consistent with 2% inflation. That would be, you need to have 2% productivity growth to make all that arithmetic work and to ensure that inflation remains near 2. And that feels like where we should be, feels like where we're going to stay. Yeah, the labor market is tight, but it's not overly tight. And it's actually eased up a bit here. Quit rates are down, which is key to wage growth. Hiring rates are down. The businesses have cut back hours. So, yeah, it's a possible scenario. Things could get overheated. Wage growth could accelerate. Inflation become an issue again. But again, I think that's not the most likely scenario for next year.
Mark, when it comes to the housing market, you mentioned before housing values close to record highs, mortgage rates, higher mortgage rates, obviously really being part of the problem when it comes to the fact that homeowners are staying in their homes. Home affordability is a real issue. Where do you see mortgage rates settling when you take a look at about a year from now, the end of 2024? What does that level look like?
Yeah, I think somewhere between 5.5% and 6%. That would be, and just for context, the current 30-year fixed rate loan is going for, I think, 6.6%. It was as high as 8% if you go back, I think at this point a couple months ago. But as you say, a year from now, looking past the near term, I think we settle in. So if I were thinking about buying a home, and I'm doing the arithmetic in terms of what monthly payment I expect to pay, I would pencil in a 5.5%, 6% mortgage rate. Say let's 5.75%. That would be consistent with a 4% 10-year Treasury yield, and that spread between mortgage rates and the 10-year yield is somewhere between 1.5, 1.75 percentage points. So 5.75%. By the way, that might not resonate with lots of people given how low rates were before the most recent period. I mean, we were down into the twos not long ago, so that will be hard for people to digest. But I think that's ultimately what they have to adjust to. Mark,
if we do see that 5.5% to 6% mortgage rate range by the end of next year, what's that going to do to inventory and ultimately to prices? Are we going to see more pressure then on prices?
I expect some price weakness. Yeah, I think ultimately, even if you get mortgage rates back down below 6%, it's still at these house prices. Housing is still not affordable for most potential first-time home buyers. So I think we will need to see some price declines. And I think what will happen is those households you mentioned that are kind of in their home with a 3.5% mortgage rate kind of locked in over time, life happens, right? Divorce, death, children, job change. People need to move, and when they start needing to move to sell that home, they're going to have to start giving a bit on price. So if you told me, a year, 2, 3 down the road, house prices nationwide are 5% below where they are today, I'd say, okay, that sounds about right to me. Which means that's nationwide. That means some parts of the country, probably the most previously juiced parts of the country, in the South and the West and California, prices could be down close to double-digit peak to trough.
Mark, always a pleasure getting some of your insights here. Happy holidays to you. Mark Zandi,
Yeah.
Moody's Analytics Chief Economist. We appreciate it.
Thank you. Take care now.
You too. Apple will stop selling its new Watch Series 9 and Watch Ultra 2 on its website after 3 p.m. Eastern Time today. The watches will also be removed from physical Apple locations on December 24th. The tech giant complying with a ruling in an intellectual property dispute with medical device maker Masimo over its blood oxygen feature. So, how will this move impact Apple? We've got Angelo Zeno, who is the CFRA Research Senior Equity Analyst, with us on this. Angelo, great to see you. What is the net impact from your perspective?
Yeah, no, thanks for having me. So, when we kind of look at Apple Watch sales, we estimate that it's about 4 to 5% of total revenue, right? And clearly in the December quarter, that's kind of their bread and butter quarter. The good news is we're talking about this kind of being completely wiped off of Apple's ecosystem. Let's say after the 24th, and you kind of just mentioned it's going to stop selling online after 3 p.m. Eastern Time today. But as you kind of look forward here, right, going into the March quarter, our view is you're probably looking at about a potential worst case scenario of about 2% negative impact to revenue. Now, you've got to also take into account the iPhone SE will continue to be sold. Not to mention, when you start thinking about it from an international perspective, that will be unaffected in terms of Apple Watch sales. You look at international sales north of 60% of their revenue over the last year. So overall, this is not something you want to see if you're an investor, but nonetheless, it's something that Apple, we believe, will be able to weather.
Angela, what about the fact that Masimo was successful in this? Because in a statement, they did come out and say that it demonstrates that even the world's most powerful company must abide by the law. Other challenges, do you see that at all likely down the line, given the fact that Masimo was successful?
Yeah, no, I think that's a great point. And, when we think about it, Apple has to tread very carefully here, right? I mean, they can technically just kind of go out and try to make an all-out acquisition of Masimo or, find some other, way to kind of settle on all this. But you don't want it to kind of open up an entire can of worms here in the future, right? So in the meantime, when you kind of think about it here, Apple really needs to tread carefully, look for a way to kind of, whether it be through legal matters or some sort of technical update, if possible, to try to kind of get around this. But I think that's an absolutely important point to kind of make out there, given the fact that this could, potentially cause others to potentially look at Apple in the future.
All right, Angela, we're also keeping a close eye on Micron because shares are trending here at Yahoo Finance this morning, extending gains in the pre-market. The semiconductor's first fiscal quarter results showing that we are starting to see a bounce back here. You're looking at gains at just about 7.5%. A lot of this is because of the guidance. They're seeing revenue of $5.3 billion in its fiscal second quarter. Angela, what did you think of these results? And does it tell us that the worst of the slump is behind us?
Yeah, no, we think so. I mean, we do believe that kind of, we kind of saw an unprecedented period in terms of Micron here over the last couple of years. They definitely benefited from the pandemic. And then you kind of look at over the last 2 years, they've really kind of had to, adjust to kind of a more normalized environment. We saw PC sales decline about 35 to 40%. Smartphone sales obviously had to take a hit, not to mention we had to see some significant inventory corrections kind of across the data center ecosystem. Now, we do believe that's kind of now in the past. As we look forward here, what we're most excited about is the fact that the supply-demand landscape is significantly improving faster than we originally anticipated. That's going to result in higher pricing, which we already did see in the November quarter. And, that should support some significant margin expansion ahead. You saw the margin number here of 13% in the November quarter. That was above consensus of about 6%. And again, our view here over the next couple of quarters, exiting calendar 2024, we wouldn't be surprised to see a gross margin number closer to 35 to 40% and profitability returned by the May quarter.
Angelo, one of the things that you also noted is that Micron expects, or at least said it expects, the supply of chips for PCs, mobile devices, other chips, reaching normal levels in the first half of next year. That's on the supply side. What about on the demand side? Is the worst of this demand environment already behind us?
Yeah, and I think that's an important question here. So on the demand side of things, we've definitely seen a stabilization in the more cyclical-oriented markets, PCs and smartphones. Whether or not that's sustainable is anyone's guess. It will depend on the macro picture. But the good thing as far as Micron is concerned, at least over the next 3 to 6 months, our view is all the growth is going to be dependent on the pricing side of things. And from a pricing perspective, we do kind of see some nice upside there. I think when you kind of look at really where the growth opportunity is long term, and even for 2024, it really is going to reside more on the server side of things. AI based servers out there, high bandwidth memory is going to be a huge opportunity for them. But specifically, when you think about servers, last year was the first time in 7 years you actually saw a year-over-year decline in data center servers. So we do expect kind of a nice rebound here to 2024. And of course, that's kind of our conviction is definitely higher because of what we've seen from some of the cloud providers out there and some of the spending plans that they've already announced for 2024. Angelo,
great to speak with you here this morning. Ahead of the opening bell, we're going to be tracking Micron, one of the trending tickers on the Yahoo Finance platform. Angelo Zeno, who is the CFRA Research Senior Equity Analyst. Thanks so much.
All right, thanks, Manny.
Absolutely. We're also watching shares of Boeing today after the company said it's going to deliver its first 787 jet to China since April of 2021. This is according to several reports. Junya Airlines will reportedly fly its new plane from Seattle to Shanghai as soon as Thursday. The deal now opens the door for potential future deliveries of the 737 MAX. Boeing shares here pre-market up by about 1.8%. It's been a big week internationally for Boeing. This perhaps alleviates some of the pressure that we've seen overhanging the airline industry, and especially for large plane orders for the manufacturers Boeing and Airbus, but mostly here Boeing in the U.S. kind of China relations front here. That is one of the larger kind of frames of mind that's been entered into. And I think the other major thing here in the international week that has been for Boeing, huge order that they saw come through from Lufthansa as well. And I think this all kind of points back to the international travel demand environment that many of the airline CEOs have continued to point out to us as well.
Yeah, Brad, my two takeaways here. One, it could be a sign that maybe some of the trade tensions between the two countries may be easing just a bit. It's still a little bit too early to call about that, but that has been some of the chatter here amongst analysts this morning. Also, though, what this means for the 737 MAX, because we know it has been just over 4 years since we have had this freeze of China not ordering any 737 MAXs from Boeing. So this is seen maybe as a sign to a more significant or a bounce back here in terms of the 737 MAX deliveries. Jefferies is out with a note on this, or some commentary, I should say, that they're saying that they do expect that to happen after the 787 delivery in Beijing will be allowed. Shanghai is allowed here. So we could see that very quickly. What the timeline looks like of that, obviously, is what is up for debate. We know the 737 MAX, very important here in terms of what it does for their profits, the big boost that the 737 MAX offers to its profits here for Boeing down the line. So some optimism here in terms of what that order book could look like in the years ahead.
Yeah, it's expected to have a positive impact on the financials here. You talk about potentially contributing $10 billion to its free cash flow target for 2025 to 2026. These orders are placed years in advance, so the resumption of delivery, a big deal, but also, as you mentioned, on the international relations front, especially for Boeing into some of these other regions. And we should note that China as well, with some of the stimulus that has been tossed around or considered going back into its economy could mean and work wonders for the experience side of that economy, where Boeing and other airlines operating within the region would be net beneficiaries of more consumers being on some of these new flashy aircrafts. I'm just going to say.
Yeah, could help them win more customers here down the line.
Yeah.
All right, well, let's talk about shares of Toyota. Toyota shares slumping after recalling over 1 million vehicles over an airbag defect. Now, the recall covering a range of Toyota and Lexus vehicles with a faulty sensor in the front passenger seat. Now, the sensor may have been manufactured improperly and caused the airbag to not deploy in some types of accidents. Now, it is the third major recall for the car maker in recent months. You're looking at shares off just about 1% here in the pre-market. Now, this is all tied back to Daihatsu, which is a subsidiary here of Toyota. Accounts for about 4% of Toyota's global vehicle sales. The offices, though, of the subsidiary Daihatsu had been raided over some of these false safety tests. Toyota now recalling over 1 million vehicles, clearly could have an impact in the short term.
Yeah, and these recalls, especially the ones that we've heard of recent, which have kind of put back into the frame of mind for a lot of car owners out there. Well, is this just an over-the-air update, or is this an actual take it into the dealership? I got to sit there, wait maybe an hour, hour and a half, 2 hours to get this updated. For all involved vehicles, Toyota and Lexus are saying the dealers are going to have to inspect the OCS sensors and then, if necessary, replace them at no cost to owners. But for all involved vehicles, Toyota are going to notify customers by the middle of February 2024.
All right, again, shares under pressure here in the pre-market. Well, you're counting down to the closing bell, just about 9 minutes until, the opening bell, 9 minutes until the opening bell here on Wall Street. Keep right here on Yahoo Finance. We've got much more of your market action ahead.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance. Shares of Paramount lower this morning on the back of merger chatter with Warner Brothers Discovery. CEOs from the two media giants reportedly met to discuss a possible deal over lunch earlier this week. Wonder where they went. That meeting first reported by Axios. Joining us now with more is our very own Madison Mills at the New York Stock Exchange. Hey, Maddie.
Hey, Brad, thanks so much. So this deal potentially bringing a merger, but not of equals here, because we have Warner Brothers market value at $29 billion, Paramount at $10 billion. Paramount down in the pre-market this morning, just a touch, while we're seeing Warner Brothers up over 1% in the morning. So seeing a little bit of green, which is particularly good for them, given all of the market puking that we saw yesterday, which we'll talk a little bit about more later. But this deal, both leaders having multiple hours of meetings yesterday talking about this potential merger and talking about the various synergies that a deal like this could bring, thinking about a CNN combining with a CBS, also bringing their sports units together, and executives saying in this meeting that these synergies could allow for a merger like this to bring this company to the ability to be able to compete with the likes of Netflix, Disney Plus, and that is a stage that we know in this streaming war continues to get more and more competitive. And on the market side of things, Paramount has a lot of distressed debt that they're trying to figure out. So this merger could definitely be something that could not only help that firm, but it's also really critical for them to figure out something that they can do to kind of shore up their finances moving forward, guys.
Yeah, Maddie, what's the perspective down there from traders or who you've been talking with in terms of analysts on the street? Could this be maybe the first of more consolidation within the industry, something that we have now been expecting for some time?
It's definitely going to lead to more consolidation, Shauna. I spoke with the CEO of Solomon Partners, Mark Cooper, just about the deal-making space. And he told me that 2024 is going to be a big year of deals, but that the buyers have to get used to these inflated prices from sellers. So obviously with Warner Brothers, we're talking about a merger rather than an acquisition, but that pricing structure is going to be something that's going to lead to a little bit of tension in these deals due to the inflated price environment that we have right now. Now, interestingly, we have seen a lot of regulatory concerns sort of having a little bit of a stall on the deal-making space, but Mark Cooper also said to me that that's kind of just a cherry on top mention that these deal makers can sort of say if they want to get out of a deal, but we've seen that regulators haven't been able to crush any of these big deals yet, so it's more of a line on a piece of paper than something that's actually going to stop a deal from happening.
All right, Maddie, stick with us for the opening bell just about a minute from now. We want to get, though, to one of the movers in the pre-market, and we're obviously expecting it to keep moving here through the opening bell, and that is CarMax. Shares spiking today. You're looking at gains just about 12.5% ahead of the open. Now, the used car company CEO touting, quote, several quarters of sequential improvements in its latest quarterly results, also announcing that it is resuming its share repurchase program, strong pricing for used cars, also cost-cutting measures helping CarMax in its most recent quarter. And Brad, when you take a look at some of these numbers, a bit surprising given the fact that average transaction prices still north of $27,000, well above historical norms. A lot of people simply cannot afford used cars.
I want to be happy about this, but I unfortunately have to tap the Grinch button on this one. They're talking about persistent widespread pressures that they've had to navigate through. That's going to continue to happen. You look at the average selling price, that's actually down single-digit percentages, both on used vehicles and wholesale vehicles. So the market's perhaps a little relieved that it's better than feared, given the environment that they're in.
And we are seeing some relief here in the major averages today following yesterday's sell-off. We've got the opening bell on the street. When we take a look at the major averages, Dow and S&P pushing higher, coming off the worst day that we have seen in months.
You got to ask yourself, who rang the bell better? Is it the Salvation Army or is it the actual bells that ring for the stock markets and the exchanges? Salvation Army doing great work this holiday season.
Not even
great to hear those
debate.
bells. Yeah,
certainly. All right, well, Madison Mills is still standing by with some of the top themes that investors are watching today. Maddie, when you're taking a look at some of the gains today, it looks like investors are using this as a buying opportunity.
Yeah, and why wouldn't they, Shauna, after the run-up that we've seen over the course of 2023? I know you guys have been talking about what happened at 2:30 p.m. yesterday, but seeing all of that red on the screen, only 19 names in the green on the close yesterday. And after we've seen 7 straight weeks of gains in the S&P 500, if we were to see the S&P dip into the red this week, that would break the longest green streak of the S&P since 2021. But as you can see this morning, so far, it's looking like we're getting that buy the dip mentality on the street. You can hear the phones ringing around me, lots of deal making going on this morning, and some of the cash on the sidelines coming in because of the opportunity presented by this dip. And that's exactly what Citi has been advising investors on. Scott Kroner with a note that you guys mentioned saying that it's time to get in on pullbacks like this. And that is exactly what you could expect, particularly when the relative strength index is showing the S&P at relatively high levels here. Also, guys, just to do a quick look on the earnings cycle, we've got Nike coming up later today. As we know, Nike's been struggling a little bit in the earnings space. I'm really interested to see whether Nike can be a bellwether for what we're seeing when it comes to consumer spending. Are we going to see Nike also be able to expand its China footprint, something we've been talking about a lot given the headwinds there, and that is going to be critical for their growth story to be able to continue. Also, Carnival obviously up an impressive 124% this year. They're adding to the earnings space today. Also today, initial jobless claims coming in this morning, which I know we've been talking about. Stuart Kaiser this morning saying that retail investors can really look at those initial jobless claims and just the labor market in general to determine whether or not this Fed put is something that the market is going to be able to continue to rally on heading into the end of this year and heading into 2024, rather, to be able to continue to see those returns and see that broadening out away from those top 7 names. If we look at kind of the market puking from yesterday, all of those stocks going down might mean that we'll see a lot more of a widespread rally when those stocks start to come up.
We like to see green on the screen after a stomach-turning type of day. Maddie, thanks so much. Well, opening bell on Wall Street just taking place here. Let's do a quick check of the markets. Jared standing by for that at the heat map and the Wi-Fi Interactive. Hey, Jared.
Hey, Brad. As Yahoo Finance's Josh Schaefer said when he came in this morning, the sell-off is over. Hope everybody bought at 3:45 p.m. yesterday. Let me show you a chart of the Nasdaq. This is going to be today. This is over the last 2 days. Got nasty yesterday after 2 p.m., and then we have just rallied minutes from the close yesterday into the open today. And let's take a look at the sector action because it has been favoring the mega caps. No coincidence that the 10-year T-note has dropped to another 5 months low. It's not a huge move, but it is down again today, and that supports the mega caps. Consumer discretionary is the number one sector, also tied about neck and neck with tech for that top spot. Communication services, another mega cap sector with Alphabet and Meta in it. That is also a leader today. Even energy pulling up the rear here is up 0.25%. If we take a look inside the Nasdaq, what a difference from yesterday. You can see NVIDIA and Meta up about 1.75%, Tesla up 2.5%. I'm going to be doing a deep dive on Tesla in about 10 minutes here. And let's just check out the 2-day performance to see if we've clawed back some of these gains. More red than green, so we have more work to do to get rid of some of those losses, claw those back, but Alphabet still outperforming by 2% here. Let me change this back to an intraday and just take a look at our leaders here. It looks like solar, that is the number one sector. That's up 3%. ARC, representing the disruption stocks, that's up 2.5%. China, KWeb, SOX is American chip stocks. EEM is emerging markets. Then we have retail, small caps, Korean stocks. So pretty healthy mix, skewed towards tech, but a pretty healthy mix that we're seeing so far. I'd like to see the small caps joining the game as this is their time of year to shine into January. They do tend to outperform. Here is the energy sector today. Total up more than 1% and not seeing a lot of huge movement otherwise. And let me get to our travel sector and let's just check out. Maddie was talking about some of the cruise lines here, and indeed, Royal is up 3.5%. Booking is up 1%. So is Airbnb. Delta Airlines up 2%, and Norwegian up 4.4%. Guys.
All right, Jared, thanks so much for breaking that all down. A look at what's taking place, what's moving here at the open. Investors are also keeping a close eye on Nike shares. This morning, the athletic footwear and apparel company set to report its Q2 earnings after the bell today. Analysts seem fairly optimistic about Nike's quarter, which will provide investors with an early look at the company's holiday shopping demand. Evercore's Michael Benetti expects a slight beat on EPS and believes Nike will hold its full-year guidance for 2024 despite some top-line risks here. Shares up by about 1.25%, we'll call it.
Yeah, there certainly are some risks. One of those, and it's going to be a focal point in this results, is China's sales there. What demand looks like, recovery much slower than initially anticipated. What stuck out to me, though, about this Evercore note was what he had to say about the longer term in terms of some of the revision work that we could see to the algo and what that means to the algorithm and what that means for their lowered revenue targets here in the long run. He does make the point that he does think it's good just in terms of what that means priority-wise, gross margin-wise for the longer-term growth story. But some of those changes, he was saying that they think a refreshed algo with slower revenue growth but a much more detailed margin build is going to be positive for the stock in the longer term. But a lot of this story, like Maddie was just saying, it's going to be about consumer demand. It's once again going to be giving us an inside look at what people are willing to spend on, what they are not spending on, where exactly that is happening. Clearly, Nike is going to give us that global picture, and China will be a focal point here.
You know, a few things come to mind to me for Nike and what we're going to be waiting to hear from the company, and a few of them called out within this. Number one, the tough comps that this company is going to be up against. You look at last year and all the demand that there was for any type of alt dunk that you could find, and then even more of the fodder for conversation or interest in what could be the metaverse dot swoosh, kind of Nike's iteration on top of what a blockchain type of or metaverse type of play would be. And so that just kind of showcased the digital dominance that they were showcasing at that point in time and the search that was flowing into them. We've retraced a little bit from that as we had seen even in TD Cowen's holiday tracker and some of the digital data. But also here, this is a company that is battling bots, battling some of the resale market as well here. And I think inventory is one of the things that jumped out to me where we might see a normalization of inventory as had been called out within this note here. The biggest wall of worry for the second quarter revenues, fiscal second quarter revenues, North America wholesale lapping an outsized 37% growth rate in the same quarter of last year. So wholesale battling the bots and the resale market, but then additionally just some tough comps that they're going up against here. Also, everyone, there's a lot of uncertainty on the horizon as we head into 2024. Investors have been cheering on the Federal Reserve's dovish pivot, but there's still the possibility that the U.S. could see a recession next year. Amid an economic slowdown, where should you be investing? Well, McDonald's and the Golden Arches might just be the perfect play. For more on recession-proofing your portfolio, let's bring in Peter Saleh, who is the restaurants and food distributors analyst for BTIG as part of Yahoo Finance's 2024 Investor Guide. All right, what's got you hot on the Golden Arches here, Peter?
Good morning. Thanks for having me on. How are you?
I'm well. Happy holidays to you.
Happy holidays.
Okay, so let's talk about McDonald's here. What is the thesis that is really setting up this play going into 2024?
So, look, I think McDonald's continues to take market share in the fast food hamburger segment. I think it's we have a buy rating, $300 price target on the name. They're accelerating development, especially in the U.S. That is accelerating pretty significantly over the next several years. So they're putting more units into the ground. Their same-store sales remain healthy. And look, we're not calling for a recession in 2024. We think the economy is still pretty healthy, but this is a name that is fairly recession resistant. And if there is any sort of consumer slowdown or consumer-led pullback, this is a name that performs particularly well given its value proposition, also given its business model, highly franchised business across the globe, and the largest restaurant company in the world. So I think this is a good play for going into 2024. Again, $300 price target on the name.
So, Peter, if you are expecting that a name like McDonald's here to outperform, what does that then tell us more broadly speaking about the restaurant sector and who else is best positioned as you look ahead to 2024?
So, yeah, I think 2024, at least we're going to start the year with a lot of discounts. We're already seeing that. And in that type of environment, McDonald's tends to take some share. But we also, one of our top picks for 2024 is Domino's. And I think that name has several specific catalysts for itself. One, they changed their rewards program, which is driving significant engagement with less frequent customers. That changed in September. They're already seeing an acceleration in traffic and in same-store sales. That happened in the fourth quarter. We think that continues into 2024. They also have the partnership. They're one of the last companies to partner with third-party aggregators. They partnered with Uber Eats. That is launching as we speak, and the advertising for that will start in early next year. And I think that is going to be a material driver of same-store sales growth in 2024 for Domino's, taking them from a very low single-digit type comp in the U.S. to a mid-single-digit. And I think in that environment, I think you get multiple expansion for this name going forward.
Yeah, I imagine a lot of consumers might like the idea of an emergency pizza if they feel like a recession might be coming on, something to continue to think about and weigh with McDonald's. I wonder who, from your perspective, has the strongest franchisee relationship going into a potential broader economic pullback, where we've been continuing to discuss with economist after economist what a recession might look like from their purview and what the franchisee relationships with these companies ultimately nets out as?
Yeah, look, I think franchisee relationships are always an interesting topic of conversation, but obviously great fundamentals and same-store sales drive healthy relationships, probably some of the best relationships going on right now. You're probably looking at a company like Wingstop, where you've got double-digit same-store sales growth. But with that said, who are the healthiest franchisees and the most financially resilient? The McDonald's franchisees still in that camp, right? Most of these guys these restaurants generate significant free cash flow. They're at or near historic peaks on free cash flow. So I think many of these franchisees are in very good shape. The Domino's franchisees are also in very good shape. I mean, cash flows are down slightly from where they were a couple of years ago, but still up substantially from where they were pre-COVID. So I think the franchise system and the franchise model is in very good shape heading into 2024.
Do you think Cosmic is at McDonald's going to drive a lot more people to say, you know what, I need to franchise a Cosmic when that's available?
I think it's one store going to 10, and we'll see if it goes beyond 10 stores. I think it's essentially irrelevant to the financials. Will it ever be available to franchisees to franchise? I'm not sure. Unlikely in the next couple of years. In my view, this could be more of a distraction to McDonald's than anything else. Keep in mind, McDonald's has a long history of second concepts. At some point, over about 20 years ago, they owned Chipotle. They no longer own Chipotle. They spun it out. It was more than anything, all the concepts that they've owned under their umbrella have been distractions to them. I don't see why this could be any different. So in my view, this Cosmix is a nice, fun project for the management team, but likely irrelevant to the financials, and really unsure if it's really going to have any material impact in terms of the ability to franchise in any time in the near future.
So Peter, why do it then? Is it just a marketing play?
I think, it's a team that wanted to try something different. Not really sure what the long-term driver behind this is to, financially. Keep in mind, again, you're one store going to 10. From there, potentially 20 or 30 stores. When you're looking at a base of McDonald's in the U.S. of 13,000 plus going to 14,000 locations, it's just irrelevant to the financials. So I think it's more of a fun project than it really is anything that's going to be a material driver of same-store sales or profit in the next 3 to 5 years.
Certainly has been lots of questions just about what the future looks like for Cosmix. Peter, always great to get your insight. Thanks so much for joining us here this morning.
Thanks for having me.
Keep right here on Yahoo Finance. Much more of your market action ahead. Stay tuned.
Tesla is reportedly facing another safety issue. Norway's traffic safety regulator has inquired into possible suspension failures in the EVs, according to Reuters. This review comes from 10 customer complaints in 2022 regarding issues with the control arm, according to the report here. Taking a look at Tesla shares year to date, up by about 105%. There have been so many things, though, to take place with Tesla over the course of this year. And I think this particular safety regulator and the concerns that have come about certainly do impact the company's broader kind of European push. However, there you're taking a look at Tesla's 2023 and everything that has been from beginning this year, the price cuts, and you move all the way through and eventually get towards the Cybertruck. Eventually you get there. But at the same time, and the Cybertruck, by the way, Elon Musk talking about that this week, saying that it could eventually be a boat as well. So a head scratcher, but we'll see if they could just get it into driveways first and foremost. But I think at the end of the day, this is a larger, and with what's taking place in Norway is perhaps a larger hit on where they're able to continue to move so much of the production that's come online within Gigafactory Berlin to service so many different parts of the European region, kind of puts that in the throes of the conversation as to whether or not they'll see a hit in demand there.
And despite all this, when you take into account there have been a number of reasons to be a bit skeptical of Tesla's performance over the last year, the stock is still up 133% year to date. So it has been favored here amongst investors. One of the Magnificent Seven stocks that have really set the pace for the entire market here for 2023. Looking ahead, though, these safety questions, probes by safety regulators, obviously a black eye here for Tesla just in terms of what it could mean for future sales down the line. Model S and Model X vehicles could be affected as a result of this probe that is going on over in Norway. I think looking out, though, all of this just hinges on the demand story and exactly what that is going to look like, how big of a player Tesla is going to continue to be in that widespread adoption story here as you look ahead to the next several years. Because when you take into account a number of these manufacturers, a number of these auto giants are adjusting their investment plans for EVs, at least in the near term, delaying some of that investment for a couple of years because demand hasn't necessarily met expectations. That could hinder some of the growth that we would see for Tesla in the short term.
You know, I just continue to be baffled by what the buoyancy of a Cybertruck would be if Elon Musk is talking about it.
You're still on the boat part.
A Cybertruck boat?
I am too.
I
made you repeat it to me this morning because I was shocked. Yeah, you know, but you shouldn't bet against him. That's one thing we have learned.
He is a scientist.
All right, well, it has been a roller coaster year for Tesla, from delivery setbacks to the launch of its much anticipated Cybertruck. Well, the EV maker made its debut on the S&P 500 back in December of 2020, but despite seeing gains over 100% so far this year, 133%, shares have lagged behind other Magnificent Seven stocks. Yahoo Finance's Jared Blickery joining us now with more. Jared.
Sean, it has been a roller coaster year, but as you said, Tesla first joined the S&P 500 3 years ago. Let me show you what it looks like in the Wi-Fi Interactive, because I think it's interesting to plot how Tesla's share price has evolved, and that gets back to supply and demand too, along with some of the other mega caps and this phenomenon that we've seen with the concentration this year. So these two lines right here, this represents pretty big increase, and that was just a time period between when it was announced that Tesla was going to join the S&P 500 to the time it has. And let me just show you another view. This is Tesla versus Apple versus Amazon from December 18th, 2020. And we can see that Tesla has had higher highs and actually lower lows than any of these two other stocks. And it's kind of in the middle of where it started here. And then let's take a look at Amazon. Amazon is well below the highs that it had in 2021 still. And Apple is kind of the opposite story here. It is making all-time highs right now. And meanwhile, Tesla has just been the high beta, I would say, component of the Mag 7. Now let's take a look at my heat map here for the Magnificent Seven, the mega caps. And this goes all the way back again to December 18th, 2020. That was the day before Tesla joined the S&P 500. And we can see Amazon's the only stock in the red right now, down 4.6%. Tesla up just barely, that's 8.7%. But you sort by performance here, and you can see some, not surprisingly, NVIDIA up 268%. That almost matches what it is up year to date. That's another story. But then Microsoft up 70%, Alphabet up 61%. Berkshire Hathaway, not a Magnificent Seven stock, but definitely there in terms of mega cap. That's up over 60% as well. I think the bottom line for investors is it's easy to group stocks together, especially when they perform similarly over a period of time. But the chart that we were showing before of Tesla versus Apple versus Amazon really shows that these are very different stocks, totally different fundamentals, and taking very different paths over the long term. So my hope is 2024 is a year where we don't have to say Mag 7 too much anymore.
You and I both there, Jared.
Yeah, Jared, thanks so much for that breakdown. Appreciate it. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Another company is riding the generative AI wave. Morgan Stanley out with a new note on Salesforce, upgrading the stock to overweight from equal weight and raising its price target to $350, the first time the firm has been positive about the company since this summer. The analyst behind the note said he's expecting Salesforce's AI app to ramp up demand for its data cloud in the second half of 2024. So this is significant here. The firm talking about several vectors that they see driving some of the upside to the top line versus the investor expectations, investor growth expectations, which they believe are muted, the analyst saying here. Particularly, though, what is catching the eye, Salesforce's data cloud offering. Traction earlier as an organization might look to prep their data for generative AI. Also, they're talking about this unrivaled breadth of front office workflows as well here. This is the company that's essentially been leaning as far as it possibly can into something similar of a generative AI co-pilot for a lot of its portfolio clients.
Yeah, certainly. And their selling points there is all about safety and responsibility within AI to corporations in terms of trying to differentiate themselves from some of the other products that are out there when you take into account some of the other leaders within this space. Morgan Stanley, though, seeing it as well positioned on a valuation basis because they're saying that low investor expectations versus the potential for the top line upside, it makes it one of the more attractive plays within the software space right now, and also makes it an attractive risk reward setup here for Salesforce. Now, it is important to point out in terms of sales and demand for its products. The analyst there, Keith Weiss, noting that he doesn't see generative AI app demand to be likely here until the second half of the year, but he does think Salesforce is well positioned going into 2024 because of the fact that companies are going to have to budget and prioritize, and we will likely see some traction earlier as organizations do prep some of their data for Gen AI, leaving a name like Salesforce well positioned. As we know, generative AI is going to be or is top of mind for CEOs across the spectrum, across the industries, and in terms of their top investment priorities for 2024. A number of recent surveys, including the recent one from KPMG, talking about how AI is playing a huge role in 2024 for companies.
CRM stock almost 100% higher year to date here, I believe about 96% based on what I'm seeing right now. And there you're taking a look at it on your screen. Hey, 100% year to date.
100% flat. All right, we'll keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Welcome back, everyone. You're watching Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. Here we're live in New York City and about 30 minutes into the start of today's trading activity. Let's take a look at how things are shaping up right now. The rally is back on. Stocks higher once again after falling midday on Wednesday.
And taking a look at some of those individual names, Cheesecake Factory and Cava are both rising after Wedbush boosted them to outperform from neutral on Cheesecake. The analysts saying that they are optimistic about the company in 2024. But for transaction growth, they are expecting that to outperform some of the peers. They're also hopeful that declining interest rates will alleviate some of the pressure that we have seen on valuation and also on consumers.
As for Cava, Wedbush analysts expect another quarter of upside compared to the company's conservative guidance. While lower grocery inflation could be viewed as a threat to the fast casual space in 2024, the analyst sees Cava overcoming this headwind.
And we are watching Spotify, the audio streamer, also getting a boost or getting an upgrade here this morning. I'm moving to the upside on that upgrade, up just about 2%. Pivotal Research boosting the stock to buy from hold, increasing the price target to $265 from $170. Now, the analysts there are saying that the company's renewed focus on financial discipline will allow for higher free cash flow. Well, Hannah Montana once said, everybody makes mistakes and everybody has those days. And it turns out, well, quite a few economists made a mistake this year in forecasting a recession. Now 2023 broadly seen as a relatively good year for the economy as inflation fell rather quickly while maintaining a strong labor market. Here to explain where economists feel they got it wrong and also what it means for the year ahead, our very own Josh Schaefer. Josh, what are you learning?
Yeah, Shauna, so I called a couple of these economists and sort of phrased it to them that way. What do you think happened in 2023? What were you expecting? And they all sort of highlighted similar things of headed into 23. Most economists saw the Fed's interest rate hiking cycle essentially slowing employment, eventually bringing the unemployment rate up, which would hurt consumers. We would spend less. We would go into a recession, right? That's the classic playbook. You can see that's part of what has happened in the past as well. But they pointed out a couple of graphs that when we talk about economists, they have models, right? We put in certain numbers into models, and that's how we create forecasts. But when you have a pandemic, the models don't work that well. And in some cases, it's really not, I would argue, not really their fault. So if you take a look at excess savings, one of the main things that was wrong, this is a chart from Deutsche Bank, you can see here pre-revision, so revision came in August, and you can see pre-revision, we thought people had a lot less money than they actually had. You can see that purple line there is post-revision. So when you're forecasting things and you think Americans have a certain amount of money, and in reality they actually have more money than you thought, it might make sense when they spend more money than you thought they could because they literally had more money. Another part of essentially the resilient consumer that we saw in 2023 was what we saw with jobs data. When you take a look at non-farm payrolls, so this graph can be a little busy. I don't want you to get caught up in those little up and down, Shauna. See that big one?
There's a lot of up and down.
See that big one with the 14? See how that's a lot bigger than we've seen in the past? 14 straight months that the jobs report beat consensus expectations. So that sort of speaks to how economists just couldn't really read the labor market in this moment. That was about triple the amount we had ever seen in a row to happen. So a big, big beat there. And then I want to go back to that Fed funds rate full screen that we were looking at to see how aggressively the Fed hiked here. You can see that 2023 hiking cycle, right? Really, really fast. Well, economists say when you think about how fast the hiking cycle was, a lot of us actually didn't get caught up in the rise of interest rates. So if you take a look at, say, mortgages, right? Mortgage is an easy way to understand how interest rates go up. What you're looking at there is the 30-year fixed mortgage. This is a chart from Bank of America. But the purple line is what people are actually paying. So as interest rates shot up, a lot of people had already gotten in at a low rate, right? You'd already gotten in at 2.5%. So you're not going to refinance to pay 7%. You're going to sit at 2.5%. Well, mortgages are 70% of household debt. So if you're not actually paying the high interest rate, you're not, again, you have more money than we thought you'd have. So it was a little bit of an unprecedented Fed hiking cycle, and really most economists pointing to that economic stimulus sort of throwing things off.
Yeah, and it's an unprecedented housing market too, and you take into account all of those factors and exactly the dynamics playing out. But Josh, I'm curious, do they give any sense in terms of whether or not some of these models are going to be more reliable next year, or is it still going to be a similar type story?
Right. So, I mean, we're talking about the forecasting industry, right? So no one's going to tell us their model isn't going to work for 2024. in the same way we wouldn't tell anyone that we're going to be bad at our jobs next year. I think that's not. Yeah, at the base level, no one's going to fully say that, right?
My base case scenario.
Right. Yes. But they did point to a couple key things, and these are things we've been talking about a lot in terms of the labor market coming into better balance, right? Yeah. That difference that you've seen between, say, job openings and job hires in that Schultz report, basically unprecedented. So it makes it hard to understand and hard to predict the labor market. And they also think something like the labor force participation rate. We now are back at pre-pandemic levels in the labor force participation rate, right? So now maybe we see layoffs actually happen, and you do see that unemployment rate tick up a little bit as people have been expecting, because it seems like overall employers have the amount of workers that they wanted, right? That was a big part of the story coming out of the pandemic, was employers couldn't get enough workers, Well, look at the leisure and hospitality sector now. It's a little bit back to normal. So then they feel like the forecasts will hopefully come a little bit more back to normal in 24.
We'll see. It's going to be put to the test.
Yes.
We're doing this segment a year from now. We'll see how accurate they are.
A lot of them say no recession in 24, though. So I think we're all rooting for them to maybe be right this year. We don't want a recession.
We very much are. Yes. A little bit different than how we were feeling about some of those forecasts at the start of 2023.
Absolutely.
Josh, thanks so much for breaking this down for us. We got to continue this conversation as the stock market rally seems to be regaining steam after stuttering midday Wednesday, and the S&P 500 in particular has been on a tear, rising to within a hair of its all-time high. But has it gone too far, too fast? That's a big question. And our next guest says that stocks are massively overbought. So what does this mean for the market going forward? We've got Jeff Bierman, who is the TheoTrade Chief Market Technician. Great to have you here with us this morning. And we've got some of your charts that we actually want to run through here. But you state that stocks are massively overbought right now. First, help us break that down.
Well, there's different technical indicators you can use to gauge it. I prefer to use the RSI, which is the RSI index developed by Wells Wilder. Anytime you get over 70, Brad, you're getting a little bit overheated, but markets can stay overbought longer than short sellers can stay solvent, as well as money managers and performance gamers can chase performance. However, when you start to get to the 80 level, it starts to get to a level of what I call FOMO, a level of insanity where you need to kind of cool things off. You often hear the term overheated economy. This is not an overheated economy. This is just simply an overheated market that started about 4 weeks ago, just based upon Fed narrative, where the market ran with it, that the Fed was going to cut rates, which they never effectively said they were going to do. They just said, we're going to pivot, we're going to pause, we're going to hold. But the markets themselves are often driven by psychology and hedging and things that sometimes we don't understand. Nevertheless, it does call, even if we don't tag the all-time high, for investors to start to tactically, what I call sector allocate, and cut back on their overweighted, overheated sectors, which include technology, consumer staples, and cyclicals, which are industrials.
So then, Jeff, if you're advising maybe investors to cut back on some of those sectors that we are seeing signs of some overbought levels, then what should people be allocating to rather than just blanket putting money to those that have underperformed this year? What are some of the key themes or key strategies that investors should be employing when they're trying to figure out how to best position?
You have to understand at some point the market's a pricing mechanism, Shauna, which simply means you can expect some type of corrective mode after the new year, sometime early in the spring. And there's a lot of unloved sectors where the fundamentals are still very strong, and yet the market has kind of shunned them. One of them is healthcare. So you might start looking at things that have actually been beaten down, things like Abbott Labs, things like Baxter International. And then on the other hand, I think that oil's got a bad rap. If we're not going into a recession, which is what the market is signaling, and I ask you or anybody out there, why has the oil market priced in a recession? And at the same time, OPEC is going to be getting together in January. They've already signaled that they're going to be cutting production, and yet it's been left in the dust. So I'm starting to rotate to healthcare. I'm starting to rotate to oil, and I'm starting to cut back on my positioning in both consumer discretionary and in technology. The two names I like best in oil are APA Corporation and Schlumberger. They're in a consolidation mode right now. They're just kind of waiting things out, but the valuations are compelling. And if we do get a bump up in price in oil, it's already priced to a recession. So if we don't get a recession, it could be a surprise upside. So that's where I'm kind of laying my bets right now. But I certainly wouldn't completely eliminate my positions altogether in tech and in consumer discretionary, just lower my weighting.
Yeah, it's interesting as well, the move that we got out of OPEC this morning, the news of Angola actually exiting OPEC, and that country actually amounts to about 1.1 million barrels per day. So we'll see what the continuing producer group impact there is on the actual prices as well. I want to also take a look at another chart that you've been flagging here, and that's on credit card balances, because when we think about the health of the consumer, especially amid this heavy spending and holiday shopping season, you've been looking at credit card balances for what reason, and how much of perhaps the fear of balances getting out of control based on where we're looking at this chart actually sitting at right now, how much of that permeates into next year, and when do we eventually see demand destruction?
Well, let's not associate interest rates on the market side with interest rates on credit cards. In other words, if interest rates come down on the Fed funds rate, that's not going to impact your credit card at all. Credit cards are set to a certain rate. And the fact of the matter is the consumer is spending like crazy now, and for a good reason. The market has provided a form of a wealth effect. With, the market up 18 to 22% this year, people are feeling good, they're spending. And with that spending, eventually comes a buildup in credit card balances. But at the same time, one of your guests earlier mentioned that we are at one of the lowest savings rates level. And even though it's revised upward, it's still at a 30-year low. So at a 30-year low on savings rate and at an all-time high in credit cards, at some point it has to give from either side. And so if interest rates are coming down in the bond market, again, it doesn't impact the credit card at all. They're still going to have to pay off. And so people are feeling good about the market. But if there's an anti-wealth effect on the market, where let's say it corrects 20% in the first quarter, that could have a rebound effect on consumers who just altogether stop spending. And it's already starting with FedEx because their shipping volumes are dropping. And it's already started with Walmart because Walmart has already said that their sales are softening, and that stock can't even catch a bid anymore. It was one of the most loved stocks, and now Walmart's been kicked to the curb. So the signs are out there. It's just that we're in the last week of the year, and there's that window dressing going on. But I think once we get past this week, I think cooler heads will prevail, and people will start to realize, listen, I've got to cut back on a lot of designer brands, a lot of things in the leisure where it's just gotten way overexposed to the upside, and the valuations are no longer compelling at all.
All right, Jeff Bierman, always great to get your insight there. And thanks so much for joining us here as we look ahead to maybe some of the plays that you think make the most sense for 2024. We look forward to having you back. TheoTrade's Chief Market Technician. Thanks so much.
Thank you, Shauna. Thank you, Brad. Take care.
Thank you. We'll keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
It appears that deal makers are optimistic that 2024 will be the return of mergers and acquisitions. That's according to KPMG's 2024 M&A Outlook survey. 2/3 of deal makers responded that they foresee next year being more active. This comes on the heels of what has been an interesting year in the space, the likes of Exxon acquiring Pioneer or Pfizer taking over Seagen. And now Warner Brothers is reportedly eyeing a merger with Paramount Global. While many other acquisition attempts have been abandoned, let's bring in Cole Stryker, who is the head of deal advisory and strategy over at KPMG, for an exclusive interview breaking into the survey findings and what's next for M&A in 2024. So if we were to kind of compare 2024 to what the reality is that's played out in 2023 is, well, what is kind of the net delta here that we're anticipating, Carol?
Yeah, so as we think about the future for 2024 and what we've seen from the response to the survey that we just conducted that's hot off the press, we did it over the last week of November and first week of December with a couple hundred executives that focus on deals. As you mentioned, Brad, that there is 2/3 of the respondents said that they're looking to do deals in 2024. And there's a lot of pieces of the puzzle that really help bring that to a reality this next year. We're very optimistic here at KPMG. What we see with our clients right now is that they're absolutely leaning in on deals. And as we look at the survey respondents, about 70% of the respondents said that they're currently working on a deal right now. If you unpack what we think 24 is going to look like, based on the survey respondents, it's quite interesting compared to our private equity versus corporate. If you look at the first half of the year, our corporates are saying that they're going to be more active in doing deals. And in the second half of the year, our private equity clients and survey respondents are saying they're more likely to be active in doing a deal. There's a lot of reasons to unpack that, but that's we're looking into 24 based on what we saw from the survey respondents.
Carol, can you talk a little bit more about that and why you think we are seeing that discrepancy?
Yeah, absolutely. So as you think about the response from our survey respondents and you just think about the market in general, our corporates are much more concerned about transformation of their business. And they are very leaning into deals that are going to help them expedite the transformation of their business. Whereas private equity is more cautious around the interest rates. And at KPMG, we believe that there's going to be 4 quarter-point drops in interest rates starting in the spring of next year. And that therefore makes our corporates a little bit less sensitive to those interest rate increases or decreases, if you will, and more bullish around doing the deal in this first half of the year. Private equity might sit on the sidelines a little bit as interest rates start to come down, as they are more sensitive to the interest rate environment in executing on deals. So I think that's a little bit of what's happening. The other thing that we oftentimes look at is during an election year, that can have some headwinds to deal activity. But based on the survey respondents, that was much lower on their list and isn't a deterrent to doing deals this year. They were more concerned around the market stability, interest rates, driving transformation for their business. And so that's, I think, why we're going to see we're optimistic to what we will see from a deal perspective in 2024.
You know, it's interesting. Something that we saw come out of the UK CMA, the Competition and Markets Authority over there, was looking across some of the soft mergers, if you will, the mergers that weren't necessarily just outright two companies coming together or acquisitions where one company was acquiring another, but perhaps just making an investment, i.e. in this case, Microsoft and OpenAI, and having some type of partnership that would come forward as a result of that. Do you foresee in 2024 more of that, where you've just got some of these companies with massive cash piles that they're sitting on, deploying that capital, and instead of making an outright acquisition, saying, hey, we can just partner and have perhaps some exclusivity around that? And what does that knock-on effect do to the M&A environment?
Yeah, so absolutely. As you think about even from the survey respondents, a big part of what they're looking to do is transform their business. There's a lot of disruption within many sectors, many industries today. And so the ability to put cash to work, like the one you mentioned, right, is a way for them to have an ability to transform their business and have more of that convergence around different parts of the industry Obviously, tech and the digital disruption is a big piece that's impacting a lot of different sectors, and with generative AI and whatnot. So I would anticipate that with the amount of cash that's sitting on the sidelines, that will be put to work in different creative ways. If you look at the cash, right, there's a lot of cash sitting on the corporate's balance sheets. There's $2.4 trillion, record high, sitting in private equity's hands. And they need to put that dry powder to work. And they will use creative ways to go about doing that.
How do you see that, Carol, disrupting or maybe revolutionizing workflow, deal valuation, activity, even employment? I mean, when we talk about the disruption that could take place as a result of this, what do you think that looks like?
Yeah, and when you say this, are you talking about generative AI?
Generative AI, yeah, just the impact that it is having.
Yeah, so I mean, as we think about it at KPMG and how we're utilizing it and have been utilizing AI for a decade, it's going to continue to change the marketplace. In our survey, we had a 53% of the respondents said that they're using Gen AI right now in the deal-making process, and 39% say that they plan to use it in this next coming year. And you can see just the adoption is really happening quickly, and it's accelerating as we think about this next year. And it's going to continue to evolve how we're thinking about doing deals. When you double click into how they're using it, it's more on the front end of the deal process, thinking about how Gen AI can help them with their deal strategy, with deal structuring and whatnot. And as I think about this next year, it's going to continue to evolve, and those pilots that people are using or the value that they're having can also move into the value creation. And that's how we see it here at KPMG, is that those are knowledge workers being augmented by Gen AI and how it's driving different insights into the creation of value from a transaction is just exciting to see what it will bring. And it will continue to evolve over the next 12, 24 months.
All right, Carol Stryker, great to have you here. Thanks so much for breaking down that latest survey. KPMG's head of deal advisory and strategy. Thanks, Carol.
Thank you.
Well, Warner Brothers Discovery pulling back from earlier gains on the back of merger chatter with Paramount. Now, CEOs from both of the companies reportedly met over lunch to discuss a possible deal. That meeting first reported by Axios, but taking a look at the price action that we're seeing shortly after the open this morning, you're looking at Warner Brothers shares down another 4% today. Paramount also under pressure, off just about 1%. And Brett, I'm taking a look at some of the chatter amongst analysts here this morning, and Barclays commentary sticking out to me just in terms of why we could be seeing some of this pressure. They're pointing out the fact that combining two of the most challenged assets across legacy media is unlikely to somehow transform the combination into a better company. They also went on to say that WBD already trades at a meaningful lower valuation than Paramount, and this gap will make it quite complicated to achieve a deal without significant dilution for WBD shareholders. A big reason why we're seeing more pressure on the stock today.
Yeah, our own Ali Canal had also written about Wells Fargo and Steve Cahill's note that was out, and looking at the propensity for a deal to actually come over the finish line here. Of course, the higher deal probability, I should say, rather, is how he was looking at this, and ultimately saying that the M&A headlines changed their thesis around Paramount given underlying asset potential here, continuing on to say that they continue to believe that it might like to sell a controlling stake to a content operator that would protect the significance of Paramount Studios, i.e. willing buyers or a willing seller here. So all in, typically, if the company that is kind of making the acquisition is seen to be paying too much or taking on too much debt that the other company may have, then you typically see that moving lower here. In this case, it's a larger question of if this merger at the end of the day be entered into, what would that debt level be that's taken on at the end of the day? And is that perhaps something that investors are trying to get ahead of as well here? Because both of these companies, the content industry right now, content is king, but cash is also king to produce that content, especially when you're going from 0 to 100 in a very finite period of time, coming off of the strikes that we've seen over the course of 2023, and a potential one for some of the set workers next year too.
Yeah, certainly, and we've seen it pressure some of the other competitors within the space. Clearly a priority, and rightfully so, to shareholders out there wanting to see proven returns and wanting to see maybe a bit of a scale back in some of these spending plans from these larger corporations, given the fact that many of these streamers are bleeding cash or in certain divisions within their company. It does seem, at least for right now, the street a bit split just in terms of whether or not this potential deal would possibly encounter any sort of regulatory challenges. All right, we'll keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. Wells Fargo becoming the first big U.S. bank with a unionized branch. Now, the bank's employees in Albuquerque, New Mexico, voting 5-3 to join Wells Fargo Workers United. A branch in Bethel, Alaska, had been scheduled to vote on joining the union today, but withdrew its effort, and this is according to a report from Reuters. Now, this comes as other branches in both Florida and California are petitioning to also join. Brad, we're talking about this just because this has certainly been the year, it seems like, of these unionization efforts. The fact that we are seeing this wave really gain some momentum. Right now, we're seeing it spread to the largest banks here in the U.S.
Yeah, the year of labor negotiations or collective bargaining, and we've seen it across, as we were just talking about, Hollywood. We've seen it already across the auto workers and in healthcare as well, too. That was significant and went under the radar in some instances because of all of the overlaps that we had seen in this kind of Gantt chart of different labor kind of negotiations that were taking place. But ultimately here within the financial services industry, some of these workers saying that they're understaffed, that they're underpaid, that they're mismanaged. I would also add here that perhaps these workers are also getting a sense that at a lot of the branches, regional branches are being restructured vastly. Less square footage, less employees necessary. However, the services are becoming more digitized. So what is the best way that they can look to, at least perhaps in this perception and these moves that we've seen, to solidify their employment is to unionize and make sure that ultimately they're not replaced, but also kind of still a tandem hand or tandem voice that is a part of this broader financial services industry, regardless of the changes that may be made at a branch level as well.
Yeah, and it's also important to point out that this vote is just the first step. They still need to negotiate on what an agreement will look like, a collective bargaining agreement, which is the contract here between the employees and the company in terms of what the terms of their employment is going to look like going forward. But like we said, this is just the latest when you take into account what has happened at Starbucks, what has happened at some Apple stores, what has happened at some Amazon warehouses here over the last several months. So these workers really trying to capitalize on this movement.
Absolutely. Well, the generative AI boom has been a big story for the markets this year. The technological breakthrough is disrupting industries from technology to finance. And a new KPMG report out today found AI is revolutionizing deal-making processes, with more than half of companies currently using generative AI for M&A deals. Here with more on its impact on the private markets, we've got Troy Pospisil, who is the founder and CEO of Entra. Troy, great to have you here with us. You think about the disruption that is set to come forth and really touted around some of the productivity that can be unlocked by engaging or leveraging AI within workforces. What does that disruption, though, look like, particularly as it flows through to different areas of the broader economy?
Yeah, well, Sean and Brad, great to be here. Thanks so much for having me. So generative AI is incredibly powerful in enterprise workflows. We're seeing the ability to automate and enhance really cumbersome, time-consuming workflows that previously took countless hours from office workers. And in particular, in private markets, there has been compounding complexity for private funds asset managers. So at Entra, we build AI-powered software that automates and enhances every aspect of the private markets deal flow. So that includes everything from sourcing and executing investments to raising and managing funds. And within the private markets in particular, there's been compounding complexity that's been driven by the growth of the industry. You've talked about how much dry powder there is. Surprisingly, 2023 was actually a record fundraising year for private equity. That has driven a huge increase in competition, the number of firms that are in the marketplace, the size and breadth of these firms. They've had to dig deeper to find investment opportunities. So they've moved globally into new regions. They've moved into various asset classes that they weren't in before, like private debt and infrastructure. And of course, in any area of the financial markets, when you see growth, regulation inevitably follows. And we've seen continued increase in regulation of the private markets. And so for private equity firms and private funds asset managers in particular, there's been a massive increase in the amount of administrative work that was essentially impossible to achieve with their current workforces. And so AI has arrived really just in time to help them automate a lot of these cumbersome administrative workflows so they can actually stay on top of and execute all of the work they need to do to manage their firms and execute on the work they need to do so they can get back to focusing on investing and working with their portfolio companies to add value.
So, Troy, I think a lot of people are asking themselves when they see this type of technology, the fact that it is disrupting the deal-making process already and what that looks like going forward, is what the impact is going to be on workers. When you talk about automating a lot of these jobs, when you talk about automating certain tasks, some people could be left in the dust or could be unfortunately cut. Do you see that, or is that simply not the case, given the fact that some of these firms are just struggling to keep up with the number of deals and the number of activity that they want to see take place at their companies?
So what we're seeing is it's a productivity enhancer, not a replacement of creative, intelligent workers. Historically, we were seeing that private equity professionals, particularly folks in functions like finance and legal, were spending 80% or more of their time on relatively repetitive, non-creative activities that didn't necessarily align with creating value for their firms, with sourcing investments, with increasing the value of their portfolio companies. And they were only able to spend roughly 20% of their time on really strategic, value generative work. And so what AI allows them to do is really automate a lot of that more repetitive work so that they can reallocate their time to focusing on the work that is really impactful and moves the needle for their firms. So it just makes them faster and more competitive. And given the increase in the competitive dynamics in the industry in general, that's a need for these firms if they're going to stay ahead of the competition and really drive market-beating returns.
So, Troy, what do you think this is then going to tell us about the activity that we could see this year? Yes, there already are expectations for a pickup in activity given the assistance that we could see from generative AI. Could we see maybe a bit of a more of activity than we had initially been anticipating?
Absolutely. There's obviously the macro tailwinds that we see in the private markets. You're seeing a stabilization of interest rates. You're seeing life in the debt markets that we hadn't seen in 2023. There's a record amount of fundraising. There's a record amount of dry powder. So you have all the macro ingredients for a really big year of private equity M&A in 2024. And AI is enabling our customers and the industry in general to just move way faster, to review more transaction opportunities, to move faster as they're reviewing transactions, to move faster through the legal paperwork as they're doing transactions and managing portfolio companies. So it is absolutely an accelerant that could enable a huge uptick in activity from private markets investors.
Troy, it was a massive hype phase into a show me story year for generative AI, and some of the private companies saw their valuations balloon. Are valuations getting too ahead of their skis in the generative AI kind of private sector right now?
Look, I think whenever you have a new technology, you see investors, venture investors in particular, get really excited. Ultimately, in any area of technology, the survival rate of technology companies is not incredibly high. You have a lot of seed stage and Series A companies that ultimately don't make it and become much larger companies. I don't think there's anything unique about generative AI. People get excited, they bid up valuations, and we've seen that here. Ultimately, what will matter is, are companies creating value for their customers? It's not about just showing up with technology and saying, look at this technology. It's about showing up to the customer's door and saying, here's the tangible value that I can create for you. And I think as generative AI gets more mature and people spend more time with it, entrepreneurs and customers alike, we're going to find a lot of really valuable industry-specific use cases, which is what we're doing at Entra for the private equity industry.
All right, well, if all of these co-pilots that some of the tech companies have been talking about come to life in 2024, then we're going to be spending a lot of time with generative AI for sure. Troy Pospisil, who is the Entra founder and CEO. Troy, thanks for taking the time here today.
Yeah, Brad, Shauna, thanks for having me.
Absolutely. Thank you. Appreciate it. All your markets action ahead, everyone. Stay tuned. You're watching Yahoo Finance.
Medical equipment maker Philips recalling several models of its medical imaging devices after the FDA issued a stark warning. It's the latest in a list of quality issues flagged by the company. Shares have fallen significantly since those recalls began back in 2021. You can see the share price under pressure, especially over the last couple of years. So the latest on that recall is Anjali Kamlani. Anj.
Yeah, that's right. So we know that we have heard about those respirator machines from Philips, but now an imaging machine is on the recall list. The FDA issuing a Class 1 or Type 1, the highest level of concern for a medical device problem. And what happened that spurred this is that one of the devices, the MRI machines, exploded basically while they were decommissioning it. And so that prompted some concerns about what is known as quenching the magnet. And I will save you the nerdy details, but basically it can be problematic. It involves helium gas. And this is what prompted the recall for about 150 machines. It's an older MRI device that was discontinued in 2014 from Philips, but this is just what prompted it. Philips has since looked at about 95% of those 150 in the US, as well as 80% of those abroad. No injuries reported, but they just basically wanted to make sure that all the others are functioning correctly. So this wasn't a stopping the product recall, it was sort of a field inspection recall. And so as you can see on your screen, we got that from Philips this morning, saying that about 95% of them have been checked and operational, the rest still underway. We spoke to Royal Philips CEO Roy Jacobs earlier, and we did ask about these continuous recalls and the company under pressure there, and this is what he had to say about that.
Yeah, patient safety and quality is paramount. And that's something that also, when I stepped into the role, I said this is the number one priority for the company. We have put a world-class team on it, and we are working through the challenge and actually making significant progress. We also saw that coming in, how the Philips recovery over the full year is shaping up. We have now 4 quarters of growth. We are actually year to date ahead of the plan. We upped our guidance twice. And we're doing that under the umbrella of looking at healthcare and how we can provide the best quality care to them, looking at the time that we can give back. But of course, also making sure that in the application, for example, of AI, we do it in a responsible manner.
So as you can see, they have been under pressure. The company just coming back from that 2021 recall, and we'll see if this new recall is just a blip or continues to put pressure on that company.
All right, Anjali, thanks so much for helping break this down. We'll continue to track this one moving forward. Well, several companies warning of an anticipated consumer spending slowdown in the year ahead, but what are restaurants seeing? And how are they navigating that possible headwind? First Watch is a daytime dining concept serving breakfast, brunch, and lunch with more than 500 locations across 29 states. Shares of the company are up more than 45% since the year began, significantly outpacing the S&P 500. First Watch's market cap currently surpasses $1 billion. Joining us with his consumer outlook is Chris Tomaso, who is the First Watch Restaurant Group CEO. I've been to one of your fine locations in Newark, Delaware, so I've had my own experience over at First Watch. Tell us, though, what are you seeing in the appetite of the consumer right now based on the ticket size, based on what they're ordering, and the amount of visits that are taking place?
Yeah, I think we're seeing, that the consumer still cares very much about hospitality and about gathering. And I think there's an underlying optimism. We mentioned on our third quarter earnings call that, our dining room traffic has been up. The consumer is opting for the full experience when they come into our restaurant. So, they're getting that extra beverage, they're getting that shareable. So, the fact that they're doing that for us is a great sign. I do believe that, consumer confidence is up. I think that, what consumers look for in restaurants are consistency, value. And I mentioned that previously that there's a consumer's flight to quality right now. They want reliable, consistent, friendly service that's at a value and high quality foods, and that's what we deliver. And so, we feel good about the rest of the year.
Chris, in your last earnings call, you also mentioned the fact that some of those inflationary pressures seem to be easing just a bit. Are you passing some of those cost-saving measures along to consumers, and what are you doing as a result here, more broadly speaking, for your menu pricing?
Yeah, so we've actually been probably one of the most conservative restaurant companies as it relates to menu pricing. So we felt like what was being experienced was transitory. So we didn't want to make a long-term permanent decision based on something that we believe was not going to be a permanent impact. And so that's how we've addressed it. And I think, our focus on having more visitors in the restaurants, so increasing traffic and not turning them away by overpricing and then therefore turning to discounting, which we don't do. We've just been very conservative on pricing leading up to it. And I think that's why we've seen the performance that we've had, because of those decisions that we made over the past really 18 months as it relates to pricing.
Yeah, you got some of your competitors out there that want to, woo people by some margaritas. Hey, I'm a margarita lover too. Why not? As much as the next person. Woo people by French fries. And so it's interesting always what really gets people back in the doors, especially in an environment where some consumers are trading down, some are deciding that we need to cook more at home. When you kind of hear from the consumer through their dollars, where are still kind of the hot spots that you're seeing them buy into this restaurant experience, and where are you having to invest to make sure that you're changing that experience as well?
Well, we're in an enviable position where we have a lot of unmet demand in our peak sales hours. So our focus has been on increasing those high throughput hours. We've heard from the customer and our consumer specifically that they love us. They want to go faster. And so we're looking at all the points of friction that might be in our system and trying to remove those and really deliver an exceptional experience. And our operations team has done an amazing job of that, and we'll continue to focus on that. So I think it's a little bit different for us. As I mentioned, we don't discount, and sooner or later, those that do will have to unwind those. And we don't want to have mixed messages to the consumer. We believe we're a high value offering and with our everyday pricing. And so that's what we're sticking to and really focusing on the quality and on their experience.
Is an expansion of hours to dinner being evaluated something that we could potentially see in 2024?
It's not. It's core to our business to be a daytime only concept. And one of the promises we make to our employees is that there's no nights ever. And that's really helped us attract the best and the brightest and historically have lower than industry average turnover. And so we believe it's part and parcel to who we are, and it's really core to our brand.
Chris, to that point then, what you were just talking about, just attracting workers, are you able to get the workers you need? We have talked to so many restaurant owners over the last several months about the fact that they cannot simply find the workers that are necessary to operate their restaurants. It sounds like that might not be the case for you.
It's not, actually. And it's interesting, prior to the pandemic, we really leveraged our no night shifts ever differentiation and employee proposition. And that allowed us to manage very well through, when unemployment was at records. And it's helped us now as we differentiate ourselves. And I think people are looking for that work-life balance. And the restaurant industry is historically known for long hours and can be a grind. And so we're definitely an outlier there by allowing people to have that career in hospitality, if it's in their blood, but still have a life after work and spend time with their families and be home every night for dinner. So we'll continue to leverage that. It really has been a key part of our overall proposition.
Chris, have you had to raise wages at all?
I'm sorry?
Have you had to raise wages at all just to stay competitive with some of your peers who are doing that, who haven't had as easy of a time here just retaining their workers or attracting new workers?
Yeah, I mean, we look at it on a market by market basis. We obviously have to be competitive if we want to attract the best and the brightest. But I think the entire package of what we offer, from competitive wages, incredible benefits, again, an environment that is extremely different than the rest of the industry has allowed us to differentiate ourselves when it comes to hiring. So, but yes, we've had to deal with not only legislative wage increases, but also market pressures. And so we've always been above minimum wage, and we'll continue to do that and provide the environment that attracts those folks that we want working in our restaurants.
Chris, great to speak with you here. Chris Tomaso, who is the First Watch Restaurant Group CEO. Appreciate the time and happy holidays.
Thanks. Same to you.
Absolutely. Well, switching gears here, Peacock is going commercial free for its first exclusive NFL games, at least in the fourth quarter. The streaming platform will test this out during this week's matchup between the Buffalo Bills and the Chargers of Los Angeles, and during its playoff game on January 13th here. So some of the details to break down, because it's sponsored by some of the key players here. Capital One, Hyundai, and Walmart are really kind of powering this and sponsoring this experience here. I had the larger question, we were talking about this in the break, of whether or not it would be similar to what we see sometimes when you're watching a kind of playing through pop up when you're watching some sports games. I think about golf particularly when, you're still seeing the players move throughout their match or their round, but the commercial's running kind of picture in picture, side by side.
Yeah, this move is a bit perplexing given the fact that we know that the NFL attracts brands that are willing to spend the big bucks on their advertising platforms here, just given the number of viewers that will likely be tuning in to this game. But Peacock taking a bit of a risk here, saying that since it is such a big push here from them, they're hoping that they will obviously have newer viewers, so they want to give them the best experience possible in order to view the fourth quarter. I've got questions, though, how exactly this is going to work. And like you brought up, too, there's a heck of a lot of timeouts in the fourth quarter,
many.
So what are they exactly going to be doing every time the players are not on the field?
Yeah, I mean,
It's going to get a bit
we know they
stale.
preserve the timeouts to be able to burn them down the stretch, gather your team, really rally the troops and say, okay, here's the play that's going to go save our butts out there. And what do? We see a commercial on the other side if you're not at the game here. But in lieu of commercials, they say the broadcasts are going to see about 12 minutes of additional content that is game-related, takeovers, some game features and whatnot, but much of this in a sponsored capacity, it seems.
Yeah, we know Peacock is spending big and betting big on sports to really hopefully drive some of their viewership. The company Peacock is expected to lose $2.8 billion this year. Let's do a quick check of the market. Still seeing a rebound following yesterday's sell-off. You had the Dow up 215 points, S&P up about 0.7%, as well as the Nasdaq. So a bit of a bounce back here following the sell-off that we saw late in the day yesterday. Taking a look at the sector action in terms of the top performers, you're seeing healthcare as an outperformer today. Consumer discretionary, materials not too far behind. 10 of the 11 S&P sectors moving to the upside. Energy just below the flat line when you take a look at the XLE.
Absolutely.
That does for us today, at least for Brad and I. But keep it right here. We have Akiko Fujita has you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita. Here's what I'm watching at this hour. Stocks are looking to rebound from the worst daily sell-off in 3 months, but could the markets be getting ahead of themselves? We're going to be discussing in the show. AI coming for your job? We're going to break down the future of the labor market amid the rise of generative AI. Plus, buy now, pay later. Americans increasingly turning to the payment method this holiday shopping season, but is it leaving consumers with phantom debt? First, though, let's take a look at where major indices are trading 90 minutes into the trading day. Things looking a lot calmer than they did yesterday afternoon, with the Dow up 226 points, the S&P 500 up more than 30 points, and the Nasdaq up roughly 110 points there. In terms of sectors we're watching, healthcare and materials leading the gains today, although we are seeing pretty much green arrows across the board there. Some economic data coming through this morning with initial unemployment claims ticking up to 205,000, but coming in lower than expected. You see the number on your screen there. And on the back of that, we are monitoring Treasury yields all moving higher today in the session, at least. Oh, actually, the 30-year yield up, the 10-year yield down, and the 5-year yield down there as well. Well, the stock market rally seems to be regaining steam after stuttering midday on Wednesday. Investors are once again hopeful for that soft landing as jobless claims this morning coming in lower than expected. That's the latest sign the labor market is still pretty resilient. We also saw third quarter GDP estimates revised lower, but still showing a lot of growth, up 4.9%. Even with all that positivity, question is, could markets be getting ahead of themselves? We have James Liu, Clearonomics founder and CEO, joining us today. So, James, can we say the rally is back on track after what we saw yesterday?
Hey, Kiko, great to chat with you. Well, I think the way to think about this is that, well, if the pandemic was the earthquake, then you had this tsunami of inflation wash over all of markets. And the key now is that that's really behind us. You know, that impacted interest rates, Fed policy, market valuations, and the like. And so to your question on the market getting ahead of itself, it is a little bit because it does what the market does, which is price in everything we know today, even if it happens in the future. But that doesn't mean that it's not directionally correct. So you look at inflation, for instance, all signs are pointing to inflation, at least at the headline level, that could get back to 2% later in 2024. Maybe core is a little bit higher. So, of course, the Fed may moderate rates at a slower pace. But you look at things like unemployment and GDP growth, and those have all been fairly steady. Even those calling for recession right now are really only calling for a mild recession. So you take all those factors together, and it does look like we'll have a much better market period going forward. So I think the caution for everyday investors is that the things that worked the last 2 years, the things that we were all worried about, that we wrote about and read about every day, those will probably change over the next 2 years. So, you know, bonds, for instance, will probably have more of a tailwind. Equities will probably look a little bit better. We'll be more focused on earnings. So the story is going to shift, and it's important that investors shift with it.
You mentioned the market getting ahead of itself. You know, we've sort of heard from Fed officials since the Fed meeting really come out and say, wait a second, we're not sure the market has interpreted our messaging because the market is expecting sort of additional rate cuts going into next year. The Fed officials making it pretty clear that that's not a done deal yet. How do you set your portfolio in that uncertainty?
Yeah, to your point, Akiko, if you look at what the Fed said in its latest summary of economic projections, they were only calling for about 3 rate cuts next year versus the market right now, which is saying 6. And there are portfolio managers out there at major institutions calling for much more, maybe 250 basis points of rate cuts. So it's a very challenging mix. I think what Fed officials are talking about is, of course, they need to not declare victory too soon. So it's a question of when they start. So right now, the market says that probably May is when this happens. It's a coin flip whether it happens in March, but it certainly will happen by the second half of next year. So to your question on portfolios, I think the question of the last 2 years has been, do bonds still work? Do they still diversify? And we had a big rout in bonds last year, but this has been a much better year. The US Ag is up about 5%, high yield, of course, much more risky and equity correlated, up about 13%. Even investment grade corporate bonds up about 8% this year. So that diversification benefit from bonds is still there. It's shown itself to be valuable this year. And it's important for investors to act not based on what happened the last 2 years with bonds, but what could happen as rate cuts start to happen.
What about on the equity space? You mentioned that what's worked in the past doesn't necessarily work or may not necessarily work in 2024. Is the pendulum swinging back to sort of the high growth names in the anticipation of rates coming down?
Well, the hope for investors over the last 10 years has been eventually we would get back to fundamentals, that it would be more bottom-up analysis of individual stocks, that what a company does matters more than macro trends. And so far, that has not happened. So I don't think we'll ever get back to that point in time. But what should happen the next couple of years is that it's less about inflation and this big tsunami that washed over markets. It's more about things like earnings and valuations. So corporate earnings to us are the thing to watch in 2024 as the market gets back to those fundamentals. Right now, when you look at earnings, you basically had an earnings recession over the last year, even though you did not have an economic recession. And in the third quarter, you had this inflection point in earnings. Q4 hopefully is going to look good as well. And if you take a look at forward-looking projections, you're looking at earnings growth that could be 11% or more in each of 2024 and 2025. So again, maybe the market is getting ahead of itself a little bit, but even 8% or 7% earnings growth over the next 2 years, that will be enough to help support markets and help bring those valuations down and make the market much more attractive.
So more upside when it comes to earnings. With that said, what are the sectors you're liking right now?
Right. So I think what we've seen the last year, of course, is that the Magnificent Seven, tech sectors, those have really driven the bulk of the rally. And we still like those areas because they represent secular trends that are independent of many of the macroeconomic factors that we've talked about. However, what we should see going forward is a broadening out of that performance if we get to a more normal market environment. So rather than just focus on tech, look at areas like financials, which have actually had a fine year, industrials, other areas of the market that should benefit as the economy remains stable, as inflation comes down, and as there's broader market support due to these macroeconomic factors.
James, what about opportunities outside of the U.S.? Any you're looking at right now, or is it pretty much overweight U.S. equities?
Well, so international has been very, very challenging over the last decade. And what you do see this year is that international developed has actually done much better because a lot of the worst case scenarios never happened. And you also have potential inflation improvements in other parts of the world. You have potential rate cuts by the ECB and the Bank of England next year. So we think the same tailwinds that we talked about in the US, maybe not to the same extent, but they will also apply to international developed markets. And emerging markets are still a toss-up. I think long-term, emerging markets are still where the growth is. It's just that it's been such a tough story over the last decade. And we think that a lot of the issues, especially in the big emerging market countries like China, that could still have a headwind effect on those regions.
Some good takeaways there, as always. James Liu, Clearonomics founder and CEO. Appreciate you joining us today.
Thanks.
Well, the Biden administration is considering raising tariffs on some Chinese goods, including electric vehicles. That's according to a Wall Street Journal report. Biden has left roughly $300 million of Trump-era levies on Chinese goods in place as the administrations remain divided over trade policy with China. As part of that policy, electric vehicles from the world's second largest economy are already subject to a 25% tariff. The Journal also reports that a bipartisan group of U.S. lawmakers requested last month that Biden hike tariffs on Chinese-made vehicles and investigate ways to prevent Chinese firms from exporting to the U.S. from Mexico. Also on that list of Chinese-made goods that could be subject to further tariffs, solar products and EV battery packs. Joining us now on the potential impact, we've got Yahoo Finance senior columnist Rick Newman. Rick, I saw the headline this morning out of the Journal. First question, why now?
I think because there's a lot of anticipation that there could be this influx of fully assembled electric vehicles from China or from Chinese manufacturers that are building those someplace else, such as in Mexico. So important to point out here, there are very few Chinese-made cars imported to the United States today. There are a couple. There's a Lincoln-branded SUV. There's a Buick-branded SUV that are made over there. There's a Polestar, which is made over there. I think Polestar actually is building a U.S. factory so that it can make them here. So there are not very many fully manufactured cars coming into the United States from China now, but China builds tons of cars and tons of electric cars, and the domestic market is not big enough to support all the cars they make. So there's a real heavy effort inside China to develop export markets. They are selling them to Europe, lots of other places around the world, South America. And it seems like only a matter of time until those cars start to arrive in the United States. So that would be a real concern for auto workers here and for all the communities that depend on American-made cars, because Chinese cars, like all Chinese products, would be considerably cheaper. So that's where this idea about adding additional tariffs on these cars is coming from. There's a trade-off here, which is that if you got lots of really cheap electric vehicles into the United States, it would be a faster transition away from fossil fuels because more people would be able to afford electric cars. It's same with solar panels, but then you would probably be losing U.S. production. So this is a tricky issue for the Biden administration to figure out.
Rick, the interesting wrinkle here for the potential for tariffs on batteries coming in, EV batteries coming in from China. What would be the impact on a car company like Tesla, particularly with the CATL batteries they have?
Well, Tesla makes batteries in China too. They make them for the Chinese market, and all the automakers are trying to figure this out. So there has been some controversy with Ford, for example, that wants to build a U.S. factory but partner with a Chinese company that simply has the expertise in electric batteries and EV components that Ford needs. So again, this is two-sided. If you rely on Chinese companies, well, they're getting a cut of U.S. business, and that runs contrary to one thing Biden is trying to do, which is develop more robust U.S. supply chains and add union jobs at those factories. But on the other hand, it's just expensive to develop all this stuff domestically here in the United States when the technology is already being built at scale in China for a lot cheaper than we can do it. It's just more expensive to do it that way, and it will slow the adoption because a big chunk of that added cost goes to consumers, and electric vehicles are, at the moment are considerably more expensive than gas-powered ones. One reason a lot of people probably don't want to buy one is they're just more expensive. So two sides here, protecting jobs in U.S. supply chains while also speeding the adoption of technology. They're kind of in conflict with each other.
Yeah, Rick, that points to the tricky balance the administration's really had to juggle. Something you just touched on here, bringing manufacturing back to the U.S. If, in fact, this policy, as the Journal has laid out, does come to fruition, how much of this you think is about bringing manufacturing back to the U.S.? How much of it is about holding off competition coming in from China, as you point out, as they have seen some of these car makers position themselves in places like Mexico, knowing that they're going to be selling, if they were able to, in the U.S. at a cheaper price point?
Yeah, we are in a new era of protectionism. I think this got started under President Donald Trump, and it has continued under President Joe Biden. It was different back in the George W. Bush and the Obama years. What has changed since then is China is no longer viewed as a capitalist partner that might be headed toward democracy someday. It doesn't look that way. China is very protectionist in its own right. It is harnessing elements of capitalism to further the aims of a pretty hardline communist government. So China has lost friends in the United States, and I think protectionism of this sort is here to stay. Again, it's a balance because the more protectionist you are, prices go up. I mean, that is inflationary because it just costs more to build stuff here in the United States with American labor, and it impedes the ability of businesses to produce stuff where they can do it the cheapest. So it is inflationary, and we know how scarring inflation can be for a lot of consumers because we just went through 2 years of very high inflation that really pushed President Biden's approval rating into the basement. So this is just going to be an interesting balancing act, but I think this is the new normal. I think this certain degree of protectionism is here to stay.
Yeah, Rick, also worth noting that this is coming ahead of a very big election year with both parties looking to highlight that they can be tough on China. So interesting conversation to watch. Rick Newman, as always, thanks so much.
See ya, Kiko.
Well, time now for our trending ticker. And today we are watching shares of Coinbase, shares of the crypto exchange popping on news that it secured a crypto license in France. France's AMF watchdog, gave Coinbase a virtual asset service provider approval, which gives the company the green light to operate digital currency services in the country. Elsewhere in Europe, the EU is working to introduce regulation that would allow crypto companies to use their approval license in one country and passport into other countries to offer their services across the bloc. This comes as the SEC is suing Coinbase and other crypto exchanges, claiming misclassification of tokens on those platforms as securities. Despite turmoil in the crypto sector and battles with regulators, Coinbase has rallied so far year to date. All your markets action ahead. Stay tuned. You are watching Yahoo Finance. Tech stocks defied expectations this year. The Magnificent Seven, that's Amazon, Apple, Alphabet, Nvidia, Meta, Microsoft, and Tesla, helped the S&P 500 reach new heights in 2023. The index currently up more than 23% this year. So which tech stocks were Yahoo Finance's biggest winners this year? And will mega caps continue to dominate in 2024? Our very own Jared Blickery is on the case for us as part of Yahoo Finance's 2024 Investor Guide. Give us the breakdown, Jared.
Akiko, the people have spoken, and the top Yahoo Finance trending stocks for 2023, they are in, and investors are expecting for the new year. Not surprisingly, in a year that was all about the mega caps, the Mag 7, they dominate the top 10 most popular pages visited by you on the Yahoo Finance app and website. And the winner by far is Tesla. Its quote page views that was seen over 300 million times this year, which is nearly double the second favorite, which is NVIDIA. All the more impressive because Tesla's returns of only 103% was in sixth place by returns, and that is behind AMD's 114% and ahead of Amazon's 82%. And I have the full list right here. NVIDIA, Apple, they take the third most popular slot with 135 million page views. That would be Apple. But the company is actually the second last by performance. Don't cry for shareholders, though. It is up a cool 50% this year. Now, rounding out the top five, we have Amazon. That garnered just under 100 million page views, then Microsoft. And by the way, these top five tickers have been perennial favorites by Yahoo Finance viewers for years. And it's quite interesting to me personally to see how crowd favorites, they can persist over many different types of market environments. And surveying expectations for the new year, no one seems to be predicting another year of domination by this cadre of the Mag 7. But regardless, the returns we might see over the next 12 months, it's a fairly safe bet that Tesla and Apple, they're going to be making that leaderboard again heading into 2025. Now, back to the present. In sixth place by quote views, we have AMD, which is fifth by performance. AMD might not be NVIDIA, but doubling the share price this year is pretty impressive, and it goes to show that there's plenty of room for contenders riding along the AI hype wave. And like an old friend or prodigal son, Bitcoin is back right there. The top Yahoo Finance trending tickers, it was at the top of the list for years, and I've been tracking these things. I can say that interest in crypto, it waxes and wanes strictly with the price of Bitcoin. Interest in Bitcoin dropped off a cliff with the crypto winter as a bankruptcy-riddled industry fought for its very life. But with the surge in price, up in October about 60% in only 2 months, Bitcoin has once again entered the top 10 in popularity. With 2024 promising to deliver a spot Bitcoin ETF, and that would be a finally there, and another bullish halving, and that's where Bitcoin creation gets cut in half. The fundamentals of Bitcoin, they are looking pretty bullish. But whether or not it makes the top 10 list next year is going to depend on how the price performs. Now, after Bitcoin, we have Meta. That is number 8, but it has actually the second highest return, clocking in gains of nearly 200%, only behind NVIDIA. And the final two trending tickers here, they are quite interesting. We have the Chinese EV maker NIO. That's number 9, though its returns are actually pretty bad. It's down 18%. But this ticker has been a top 10 favorite for years, and it's also a day trader favorite, as is Palantir, by the way. This cybersecurity stock that is a top 3 in returns, up 173% on the year. A lot of traders would say, why Palantir, why NIO? Difficult to say why day traders gravitate towards certain stocks, but it depends on liquidity and how these stocks trade around events, and also on a day-to-day basis. It's not always about the absolute gains. In general, thinking about this list will evolve and how it's going to evolve in the new year, we might be surprised to see another year of mega cap domination, but at least a few are going to make the list, like Apple and Tesla. And if crypto continues its blistering ascent, we might see another crypto ticker like Ethereum or Cardano actually make the list. But do not count out the retail trader. 2021 is not forgotten, and we might see a few meme stocks in there come December 2024.
So, Jared, a lot of that was kind of a look back at what we saw in 2023. Any surprises as you look ahead to 2024 in terms of where investors are headed?
I think meme stocks are not, one should not count them out. We do have the top 20 list, and so this is 11 through 20 right here, and you can see AMC is right in there, and that's despite an 85% drop. You'll also see GameStop in there despite its 9% drop. So as I said, these favorites, you might see a favorite that persists over time despite these negative returns, but you will see the top 10 list kind of recirculate some of these names. So if it's not the Mag 7, it's going to be a new group, but I think with all the interest that we've seen in tech, might be spreading into other industries. We might see a couple of oil and gas favorites in there. Hard to say what that would be, but Occidental Petroleum comes to mind here, and also the chip stocks. If the AI wave continues, definitely going to see names like Intel and AMD and some others perhaps join the top 10 for next year.
Okay, certainly going to be an interesting one to watch to see how much momentum can continue going into 2024. Thanks so much, Jared. Well, it has been a formulative year for generative AI and for the companies adopting these tools. Gen AI has also been making major inroads into the financial sector as people's finances. Our next guest is doing a deeper dive into how generative AI upended payment companies, credit unions, and financial services jobs. Let's bring in Daniel Wolf, Content Director for Credit Unions and Payments at American Banker. Good to talk to you today. This is a very thorough report that you've put out, really looking at all aspects of disruption in the space. I wonder if we start with the cards, because you sort of laid out Visa as well as MasterCard. Even within that space, interesting to see how broad the disruption is likely to be.
Oh, absolutely. And these are companies that over the past many years have tried to reinvent themselves, not as just networks that money moves over, but as technology partners for the banks and merchants that they work with. So it's no surprise that they're investing hundreds of millions of dollars into artificial intelligence and finding use cases that are of immense use to all of these audiences. Fraud detection, customer service, programming, all sorts of things that they are investing in now and plan to continuously roll out in the year ahead.
Customer service, something that we have seen sort of that first use case for in Gen AI. But as you talk about fraud detection, I mean, what kind of integration are we talking about? And to what extent is that likely to help with costs for these companies that I imagine have spent but also lost a lot on fraud?
So this dovetails with another trend we're covering, which is faster and real-time payments. Over the summer, FedNow, the Federal Reserve's real-time payment network, launched, and that provides a second option along with something called the RTP network for banks and credit unions to enable real-time payments. Now, with real-time payments comes real-time fraud or the risk thereof. And that's the sort of thing that generative AI is very well suited for, because generative AI is good at attacking problems where you need speed and you need scale that a human being may not be able to provide. So looking at a large amount of transactions, seeing the patterns in them and being able to stop them in an instant if they think they are indicative of fraud is a big deal for any company that wants to adopt real-time payments. And there are benefits to this as well. It's not all risk. They want to be able to allow people to pay their bills. They want merchants to be able to pay their invoices, to get funding from loans, government benefit disbursements as well. There's a lot of upside and a lot of appeal to this, but only if it's able to control the fraud as well. And so payment companies are laser focused on this problem and see generative AI as a tool to help them tackle it.
Daniel, the consistent concern around AI in general has been about how it's likely to eliminate jobs across sectors. I wonder what you found in looking at financial services and what kind of disruption we're likely to see, at least in the labor market there.
So it is going to disrupt that. It is going to eliminate jobs. You see Klarna already, which is a Swedish buy now, pay later lender, saying that they're going to be hiring only engineers, and that through attrition, any jobs that leave, they're going to attempt to replace them with some kind of AI. Now, at the same time, you see AI being seen as an assistant or a co-pilot for jobs that exist, and companies looking at ways to make their own workers more efficient, to make communication better across departments by allowing access to tools that didn't exist before. So you have it both ways. AI targets the jobs that are niche, single focused, laser focused on a particular task. And maybe there's even a skill that's dying off, like a particular programming language where experts are harder to find and you need AI to handle the translation of that into more modern code. That's a use case where a job might have been going away anyway. But also seeing it enable new opportunities for technology workers. Banking and financial services is essentially a technology industry. Goldman Sachs, a quarter of their employees are technology folks. So you see these companies already see themselves as technology companies, see themselves as technologists and tech vendors and want to have that advantage that AI gives to them and their workers as well.
As we pointed out, Daniel, this is a 4-part series, quite extensive in terms of the payment space. As you went through sort of the impact on all parts of the sector, what was the biggest surprise for you, the big takeaway?
The big takeaway, the big surprise was just how much these disparate ideas intertwined. Like we talked about real-time instant payments and the intersection it has with AI. We also, I don't think we talked yet, another article that we had in this package was about the next phase of digital wallets. Now, we all know Apple Pay, Google Pay, and those are focused on the point of sale and traditional shopping. But as we get into Web3 and digital identification and other uses of a concept of a digital wallet, we're going to see other companies come in and try and take over that space and maybe take over the roles that Apple or Google have today for consumers, for businesses, and so forth. And again, this is something that's enabled by the current wave of technology that we're seeing, that things like blockchain, AI are changing the expectations of what people have. And so they are enabling this innovation and also solving the problems that these innovations bring along with them.
Yeah, fascinating to see the shift that's happening there. Daniel Wolf, American Banker, Content Director for Credit Unions and Payments. Good to talk to you today.
Good to talk to you. Thank you so much.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Citigroup is now divesting its distressed debt trading business as part of the bank's ongoing restructuring that CEO Jane Fraser announced in September, according to several reports. Let's bring in Yahoo Finance's David Hollerith to get more details. David, what more do we know?
Yeah, Kiko, so dismantling this business impacts approximately 20 people, according to a report from Bloomberg. And Citi has declined to comment on this exit. But, you know, the context, it's just the latest example of what the bank is willing to do to bring itself back to profitability in terms of shareholder return. So distressed debt is a high-risk business. a bit more eyebrow raising actually was Citi's exit of its municipal business, which we learned last week, where they're a clear leader. Both of those businesses do require a lot of upfront capital, and they can be less steady in terms of predictability of revenue. But going back to what's going on here, this is part of sweeping reforms under CEO Jane Fraser. Along with exiting these businesses, Citi is also trying to get out of about 13 different consumer bank franchises across the world. And it's in the various process of doing that. Some of those areas are a little bit more tricky to get out of. It's also trying to eliminate several layers of middle management, which has meant more layoffs. Outside of that, the timing of all this, of what the full extent of these changes could mean, will come at fourth quarter earnings, which will be in mid-January. After that point, we're going to see exactly what these changes actually bring in terms of profitability around the first quarter in April. That being said, the bank has set this profitability metric using return on common tangible equity, which is ROTCE. It's sort of a banky, wonky term, but essentially they set out to go to 11 to 12% ROTCE by 2025, sometime between 2025 and 2027. Last quarter, they were at 7.7. So that shows there's still a big gap, plenty of more work to be done. And CEO Fraser needs to show results. So we're not expecting a stellar fourth quarter. This is a time for the bank to clear the decks, as they say. But that being said, a lot of pressure and a lot of history here, too, in terms of Citi needing to do reforms.
A lot more changes also expected going into 2024. David Hollerith, thanks so much for that. Well, retail sales are expected to reach new records this holiday season, fueled in part by buy now, pay later loans. Americans increasingly turning to the option to stretch their dollars as they juggle higher rates and higher prices. That could spell trouble down the line, though, with a report from the Consumer Finance Protection Bureau finding more than 40% of pay late users had actually overdrawn on their bank accounts in the last year. Our next guest says he's already seen a 33% jump in spending this season. Let's bring in Simon Khalaf, Marqeta's CEO, to discuss more about where the consumer is using buy now, pay later. Good to talk to you today. Talk to me about what you have seen in terms of spending habits from the consumer in this space.
Kiko, thanks for having me and having Marqeta. And it's great to be back on Yahoo Finance. I was part of your team before. So it is indeed, I'd say, a holiday season that's fueled by buy now, pay later. Indeed, we have seen a 33% increase in buy now, pay later in the week leading into Cyber Monday, and that has not gone down. So definitely the trend is in retail, which is discretionary spending. But we've also seen it go into and bleed into travel and entertainment. We've seen BNPL in airlines or airline tickets go up 34%. And restaurants and bars go up 23%. So definitely some really interesting trends with buy now, pay later. It is clearly contributing to our economy.
Simon, in the data that you just shared, are you finding that the consumer is using buy now, pay later instead of their tapping into their credit cards, or using it in addition to credit cards?
It depends. We are seeing, we've conducted a survey, and about 28% of consumers said they would not have made the spend if it weren't for buy now, pay later. So it's definitely accretive to the economy. But we see another sector that is using it in lieu of credit cards. And it's actually a very simple answer why this is happening. When in credit cards, your APRs are approaching, which is the interest you pay, is anywhere between 22%. and 29%, while in buy now, pay later, it's actually interest free. So the consumer is benefiting from buy now, pay later versus traditional credit cards.
What does this mean for a company like Marqeta?
Well, I mean, Marqeta powers the majority of buy now, pay later, then definitely we benefit from that growth. But Marqeta also powers a lot of the traditional credit card business. And we expect that the same technology and the AI, the generative AI that has powered the underwriting of buy now, pay later and reduced the risk with credit to bleed into the credit card business and reducing the credit risk as well. So it's excellent news for Marqeta.
Simon, the huge popularity in buy now, pay later, particularly at the height of the pandemic, really fueled concerns about sort of the reckoning on the other end. Now we're talking about potential phantom debt, maybe for users who are trying to stretch their dollars by going with this option. How big of a concern is that for you?
Well, we're technologists. We look at science, and we're not concerned at all for several reasons. The first one is buy now, pay later is actually interest free. So the risk on the consumer is lower because let's say you buy an item for $100 at 22% interest, you're actually spending $122. While if you use buy now, pay later, you're only spending $100. The second thing is buy now, pay later underwrites a certain transaction and doesn't underwrite, basically writes a blank check for consumers. So the risk in BNPL is significantly lower than it is for traditional credit cards. So, and because technology is in, you have AI that is doing underwriting decisions in a fraction of the second, and it can actually curb the spending if consumers reach a certain point that their inability to pay back the buy now, pay later loan, it can automatically curb it down. So we do believe that generative AI is what is going to stop consumers from going into what I would call the risky debt territories, something that the credit card industry has failed to do over the last 50 years. So I think we're extremely hopeful, and we are looking at technology and in general, and AI in particular, in order to reduce the defaults. So we're very positive about this trend.
Simon Khalaf, Marqeta CEO, good to talk to you today. Appreciate the time.
Great to be back. Thank you.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, if you feel like you've been swiping your credit card a lot more than usual, you are not alone. U.S. credit card lending is surpassing pre-pandemic levels. That's over $1 trillion this year. And folks are increasingly defaulting on payments. Auto and credit card payments at least 30 days past due are up for the 7th straight quarter. With those balances and defaults on the rise, many shoppers are increasingly turning away from credit cards and toward buy now, pay later services, especially in the key holiday shopping season. Well, with the rise in lending and delinquencies, the question is, how are consumers' credit faring? Let's bring in Silvio Tavares, Vantage Score CEO. Silvio, good to talk to you today. I'm not sure if you've been listening to that conversation we had before this segment, where Marqeta's CEO was talking about buy now, pay later, the surge he's been seeing. So there's not as much of a risk when you use buy now, pay later. I take it you probably see it differently, given where credit scores have gone for consumers.
Well, Akiko, thanks for having me on. Yes, as you know, Vantage Score is one of the 2 national credit scoring companies. We're used by about 3,000 banks and fintechs and a number of the buy now, pay later companies as well. And through the end of November, in our most recent monthly credit gauge, we are definitely seeing some new trends emerge, as you point out. We're seeing 3 things. Consumer confidence is high. We're also seeing credit card balances increasing, but cause for concern. The third thing we're seeing is that delinquencies are actually also rising. And so I think there is definitely some risk on the horizon, but right now consumers are feeling good. They're feeling healthy.
The question is what happens come January and February when those bills come due? What are you finding in your data? I'm not sure if you're finding this in your data about how consumers or when consumers are turning to credit in their purchases.
Well, generally speaking, we're seeing consumers with a high level of confidence. That's why they're actually increasing their use of credit. Through November, credit card balances were up 9% year over year. But as I mentioned, we're also seeing an increase in delinquencies. Delinquencies across all credit products, whether it's auto loans, credit cards, all of those delinquencies are increasing. And through November, they were at 12-month highs. So as we look to the future, there is some cause for concern because, of course, everyone's been following the big story of the year around federal student loans. Many consumers are going to have to start to repay those. And we anticipate that there could, in fact, continue the trend of rising delinquencies. As it relates to buy now, pay later, we're also seeing what lower income consumers are doing. Many lower income consumers, and we define those as typically as 50,000 in income or less. Those consumers are increasingly maxing out their credit cards, and that is a big reason why they're turning to buy now, pay later, because their credit cards are maxed out. And that consumer, especially if they're younger and lower income, oftentimes that same consumer is falling behind on their credit card payments, which is the reason why they are shifting to buy now, pay later. So there is definitely some cause for concern. So we got to just watch that as we enter 2024.
On credit card delinquencies, how much of that is driven by those higher rates? Consumers maybe sort of swiping without thinking, and then when the payment comes due, realizing that payment is going to be a lot higher because the rates are higher now.
You're absolutely right, Akiko. And there are 2 factors. Yes, the inflation, the increase in interest rates is driving higher payments, and that causes people to fall behind. But for most of this year, the other story has been around inflation. The goods and services people are buying are costing more. Now, the good news is we're seeing that inflation moderating really across the board. But for example, for gasoline, gasoline prices are down about 3% on a year-over-year basis. And so we're starting to see some of the things that were causing people to fall behind, like rising prices and rising inflation. We're seeing that moderate. That's good news. The question is, will that continue into 2024? And we're monitoring that really closely through our Vantage Score credit gauge.
You mentioned the repayments of student loans. Some of that's already been reflected in the data that you pointed to, but a big chunk of that is going to come through come 2024. To what extent does that increase the risk to the upside? How much more of that are we likely to see?
Well, it definitely increases the risk as we look into 2024. We've done some analysis on this at VantageScore, and we think that in a worst case scenario, as many as 70% of consumers might be unable to resume paying their loans. And so that would be very significant. And we anticipate that that could actually drive down the average credit score. Through the end of November, the average Vantage score was 701. A bad score is about 300, 350. A perfect score is about 850. So with the average Vantage score being 701 through November, actually consumers are pretty healthy. But if we look forward into 2024, what we could see is a lowering in that score as delinquencies continue to rise and as consumers have additional obligations to pay, like their student loans. If they miss those, we anticipate the average Vantage score could drop by as much as 9 points in 2024. On the flip side, if we see consumers making preparations to pay those loans back, there's a silver lining there. Consumers could actually boost their score on an individual basis by as much as 8 to 9 points. So it's unclear exactly what's going to happen, but it does appear that there could be some additional stress coming, particularly for lower income, younger consumers, and that could impact the credit score. That's why we tell consumers, check your score. That's the first and most important it's the first and most important step in managing your financial future. Is really understanding your credit score. There are a lot of apps out there where you can check your Vantage score, and then you can see how your day-to-day behavior in terms of using credit cards, paying them off on time, how that's going to impact your score. And it's more important now than ever because, of course, interest rates are high. So if you have a good score, you're going to be able to get the best interest rates. If you have a low score, it's going to be a higher interest rate.
Yeah, check your score and plan ahead. Both good pieces of advice there. Sylvia Tavares, VantageScore CEO. Good to talk to you today.
Good to speak with you, Kiko.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, if you're doing most of your holiday shopping online, retailers may be taking more of your data than you realize. According to a new study from IXIC, 6 out of the 10 largest retailers in the U.S. are collecting sensitive personal information that could even include your social security number. Yahoo Finance's Brooke DePalma looking into this for us today. Brooke, what can consumers do to protect themselves?
Yeah, Kiko, good morning. Well, just to note here, this information that IXIC put out is based upon the California Consumer Privacy Act. So it does say that residents outside of California could have even more data collected. But as you noted there, Walmart, Costco, Kroger, CVS, they're just some of the major top retailers that are collecting this information from social security numbers to even union membership status. And, this report also found that other stores like Amazon and Home Depot collects professional or even employment-related information. And most of the names like Walmart, Amazon, Lowe's, Target, you think of all these companies that have really seen an uptick, a boom during the past few years when it comes to shoppers going online or using those new refurbished apps that were largely launched and pushed out during the pandemic. Well, some of those can even have approximate location of consumers. But what consumers can take away here is that it's really important to check your settings, look twice. There are many ways to opt out of these major retailers collecting your information. So it's important to check your settings. For most of the retailers, you could opt out, especially that location data that got a major attention earlier this year. But as you see here, for one retailer, CVS, well, this report said that there's not many optionality opportunities for consumers here. And so it's important to really understand and look into where exactly you're giving this information, just how much information you're giving, and making sure that you're opt out of maybe location data as well as other information that they could be collecting on you.
Okay, some important takeaways there as everybody does their last minute holiday shopping. Although I should mention, if you're shopping online, you're not going to get it in time for Christmas, right? At this point.
Unfortunately, Kiko, I tried, and
probably
that's the truth.
Yeah. Too late for online shopping to make it for Christmas. Brooke DePalma, thanks so much for that. Let's do a final check of the markets as we head into the noon Eastern hour. We have seen a bit of a bounce back across all 3 major indices after that sell-off we saw on Wednesday. The Dow now up 172 points, the S&P 500 up 28, and the Nasdaq up 118. That does it for me in this 11 a.m. Eastern hour. Much more to come here on Yahoo Finance. Keep it right here.